member who said, simply put, time is of the essence, adding that it's not tenable for you to remain as leader. Why? Because they're concerned about the economic threat coming from the United States, and they need to be prepared for that, not hanging around with this lame duck prime minister.
You know, when you see CEOs get fired at the stock rallies, how embarrassing is it for Justin Trudeau that he's talking about conversations happening about him resigning and the currency's rallying off the back of that? What does that tell you? That's like the CEO story on steroids. That's shocking.
I would argue that the embarrassment's been going on for quite a while with some of the stories and some of the internal dissent, even from his own party, nonetheless, the finance minister. But yes, there is a real question here. How quickly can they get certainty? And will he allow that process to start sooner rather than later?
Speaks to what investors think is good for the country right now, that's for sure. Let's turn to Italy. Italian Prime Minister Giorgia Meloni meeting with President-elect Donald Trump at Mar-a-Lago over the weekend. A person familiar with the matter telling Bloomberg the two discussed a wide range of topics, including tariffs and the arrest of an Italian journalist in Iran.
So these were the two main topics on this list, and it wasn't just President-elect Trump that was there. Treasury Secretary Scott Bessent was there. Incoming Secretary of State Marco Rubio, his national security advisor, was there. So you can see, based off the people in the room, what was likely going to be discussed with Giorgia Meloni. I will say, for Giorgia Meloni, this was politically a very smart move. President-elect Trump is likely going to bash a lot of European leaders he invited to inauguration who decided not to come. She got ahead of that. At the same time, she's able to also stay away from the inauguration and likely show Ursula von der Leyen and other members in Brussels that she could be the main voice and conduit to this incoming administration.
For a long, long time, we had US presidents talking about, I don't know who to call. When I call Europe, who do I call? I think now when you call Europe, you call Giorgia Meloni. That's the face of stability in Europe, and there isn't much stability elsewhere, that's for sure.
How do you think Germany feels about that? That the face of Europe, the face of stability, is the Italian prime minister at a time when it's unclear who is exactly going to be the ruling party.
Well, exactly. Who's going to be the face of Germany? What does the future look like in France, let alone what is going on in the United Kingdom? One thing is for certain, Giorgia Meloni is sticking around, and it was so apparent, we talked about this a few weeks ago, at that G7 meeting. She was the standout, the only one that was likely going to be left amongst all those leaders.
So Joe Biden is still the president, just to reiterate that. And his latest decision has attracted some controversy. Shares of Nippon Steel sliding after President Biden blocked the company's planned takeover of U.S. Steel. The two companies describing the decision as political, saying in a joint statement there was no evidence of a national security threat and they intend to challenge the order. This came from Richard Haas, posted on X over the weekend. The decision to block Nippon Steel and the purchase of U.S. Steel is bad economics and foreign policy, both. It threatens jobs here, encourages protectionism elsewhere, and undermines what has been a defining alliance-first approach to the world. It's a stain on Biden's legacy.
It also politicizes CFIUS, which many in the markets have trusted for this is going to be serious when it comes to deals that are being done and actually protecting the U.S. from national security concerns. We do know that Nippon Steel, according to local press in Japan, will have a press conference tomorrow. And the Wall Street Journal, based on what Richard Haas was saying and also based on some of the conversations I've had, gets to the point this morning about that push and pull between Biden's domestic advisors concerned about those union jobs in Pennsylvania versus those like Secretary of State Antony Blinken and Jake Sullivan, his national security advisor, on the fact that actually you might be damaging relationships when it comes to Japan. If you're a Japanese company, how are you thinking about potentially investing right now into the United States?
On the way out the door, and that list of people, very long. Let's turn to China. The country's central bank reaffirming its support for the yuan, setting a stronger daily reference rate and planning to sell more bills in Hong Kong to help stabilize the currency. Investors remaining cautious due to China's sluggish economy and the threat of higher U.S. tariffs. Leland Miller of China Beige joins us now for more. Leland, Happy New Year and welcome to the program, sir. Last week, Lisa and I were talking about whether China would look to embrace the weakness of the currency to offset the threat of tariffs. Are you seeing signs that maybe point to the opposite?
No, I think it's too early to tell. I mean, I think if China has a plan to use the currency to push back on tariffs, it's going to wait until tariffs are in play before it does that. There's weakness in large part because the dollar is super strong right now. Everyone looks at Trump's plans for 2025. They see a stronger dollar there too. So right now, this is mostly a strong dollar story. Of course, the yuan, they're going to be moving it around based on what they think they need to do. But this is actually an expectation of what Trump policy will be, that will move it, not try to get in the right place before Trump gets in office.
Just to sort of broaden out, Leland, how much are the Chinese authorities preparing for what Trump is going to do with the idea of a bazooka versus other measures that we're already seeing with cybersecurity issues popping up all throughout the government as well as telecom companies in the U.S.?
Look, markets love the idea of bazooka because it makes problems go away. That the Chinese are not looking at a bazooka unless things absolutely fall apart. And one of the things that we've been stressing for the last several years of China Beige Book data is, yes, you've got a very weak economy. Yes, the Chinese economy has got plenty of problems, but that it's not a collapsing. It's not in dire straits. So in a most extreme, China tariff scenario, you could certainly see the Chinese leadership wanting to go bigger in a way they haven't for a long time. But I don't think they're anticipating doing that. I don't think that that's likely to happen in the near term. And so at this point, a lot of what we're looking at right now is the Chinese economic leadership getting ready to react to what they see. But bazooka's stretching it a bit.
Leland, just to sort of pull this together, is it fair to say that Chinese authorities are not as interested in propping up the economy? Yes, maybe putting a floor under how far GDP can fall, but not necessarily propping it up, as they are countering in an offensive way some of what the U.S. may be trying to do.
I think that's exactly right. And that's what markets, again, continually get wrong on this. Back in the old days, we know that Beijing loved to see high levels of growth. They said, look at our leadership. We're great because we're making you rich and we're delivering high levels of GDP. That is not the way the Chinese economy runs anymore, and it's not the way that Xi Jinping thinks. What they want to do, if they have more economic problems, is counter that with some stimulus that will stabilize the economy, put a floor on the economy. But they're not reaching for higher growth. They are not reaching for the old stimulus playbook. What they want to do is make sure that the economy is not doing too poorly. It doesn't have a doom confidence loop where everything is sort of spiraling downwards off itself. And they can focus on what they really care about, which are national security priorities, not high levels of growth.
Speaking of national security, Leland, I know you've written a ton about the tariff approach the incoming administration is going to take on China. Well, this morning, the Washington Post is saying this is going to be only covering critical imports. You talked about the two approaches, which seem to be much higher and broad-based than just critical imports. What do you make of this latest reporting, and what is it telling you about what the incoming Trump administration may levy on China?
Well, this is sausage being made. So you've got two issues. You've got the China tariffs, and separately you've got a discussion of global tariffs. Global tariffs were never going to be levied. Here's one rate, and that's it. You're going to always have exemptions. If it was a 10% global tariff, you have to have a certain number of exemptions. If you have a 20% global tariff, you'd have to have enormous exemptions. So what the approach is that it's reflected in the Washington Post is that they're saying, okay, well, instead of starting with a base tariff rate and saying we're going to just chop out exemptions here, we're going to talk about a handful of sectors that are going to get this global tariff rate, and then we're going to add on to that as we think we can get away with. But a lot of this is simply the approach, and a lot of this is what happens where the transition becomes the administration, and you've got all these economic officials who weren't counseling the president before saying, no, wait a second, we've got a different approach on this. So I think that this is actually still a work in progress.
How much of this is national security versus actually deal making?
Well, there are certain things that are deal making. When you look at what the tariffs threatened on Mexico and Canada, for instance, these are sort of a threat. Take care of the fentanyl problem, take care of illegal immigration, or else. When you look at China and you look at it to some degree the global tariffs, this is about the idea that the huge U.S. trade deficit is a national security issue. It needs to be dealt with. Bilateral trade deficits are problematic with China. Global trade deficits are problematic because they have it's a pushback on American workers. So I think right now a lot of this is extending beyond deal making. There's also an issue with tariff revenue being used as a pay for the tax bill, which they'd like to do. So I think the broader takeaway here is that markets have been sort of underestimating how much the Trump administration likes tariffs. as more than deal making. They see it as something structural they can use to restructure the domestic international economies. I think we're going to be seeing a lot more tariff talk than the street has been expecting.
Leland, and I'd love to finish on the domestic economy in China, just away from the tariff story, and think about international brands. Autos, luxury brands, foreign brands are looking for a cyclical upturn in the economy, looking for any kind of green shoots, a bounce, if you will. Are you seeing signs of them suffering from just a cyclical downturn, or do you think there is a real shift towards national champions away from foreign brands?
Well, we've been seeing a structural slowdown for a long time now. It doesn't mean that as you provide more help to the economy, you can't see some cyclical upticks, but that's not what we've been seeing. What we've been seeing is that manufacturing for a couple of years has been the growth leader. Exports. They're under extreme pressure right now and will be even more so in 2025 because of trade frictions. We have not seen a bounce in retail and services. They're still doing quite poorly, even after this, supposed mega stimulus that was supposed to have come at the end of September. So enormous pressure on domestic demand. Not a lot of reason to believe that this is going to turn up unless you're one of the people who still think that China is going to push that button, get that bazooka, restructure the economy towards domestic consumption, and all will be well. But obviously, China Beige Book is not in that camp.
Those people do exist, Leland, beyond China Beige Book. They're not going away. Leland, appreciate the clarity. Thank you, sir. Leland Miller there of China Beige Book. The latest on over in Asia. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, we begin with that breaking news from earlier in the hour. A new report from the Washington Post suggests that President-elect Donald Trump is exploring a universal tariffs, but they would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plan on imposing duties on every country. It would be a paring back of the most sweeping plans from Trump's 2024 presidential election. In a rare Sunday ceremony, President Joe Biden signed the Social Security Fairness Act to increase Social Security benefits for over 2.5 million retirees. The bill changes the formula that had been used to reduce benefits for certain beneficiaries, like those on government retirement plans, including police officers, firefighters, and teachers. The law is expected to boost Social Security payments by an average of $360 per month. And in South Korea, investigators have asked the police to execute a warrant to arrest President Yoon. The court-issued warrant is set to expire by the end of today. Investigators' initial attempt to arrest Yoon last week was unsuccessful and led to a standoff with his security team and thousands of supporters. It's still unclear whether or if a second arrest attempt may take place. That's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the dollar rally taking a breather.
It's not just about better growth in the U.S. It's also about the U.S. asserting itself geopolitically and strategically. Of course, this is good for the dollar. People want to be in strong countries, not strong economic countries, but strong political countries as well.
That conversation up next. Live from New York. You're watching Bloomberg TV.
In case you missed it on Bloomberg, the China Show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Snapped a 5-day losing streak on Friday's session, looking to add to those gains this morning, up by 0.7% on the S&P. Some dollar weakness out there. Euro dollar 104 session highs are up by 1 full percentage point. Under surveillance this morning, the dollar rally taking a breather.
It's not just about better growth in the U.S. It's also about the U.S. asserting itself geopolitically and strategically. Of course, this is good for the dollar. People want to be in strong countries, not strong economic countries, but strong political countries as well. I don't think that the U.S. is trying to effectively dissolve the European Union or destroy Europe. It's maybe to weaken Europe, if only to strengthen it down the road by having Europe make that choice.
So here's the latest this morning. The dollar rally taking a breather after climbing to multi-year highs. Jane Foley of Rabobank expecting further strength in the future, writing the anticipation of pro-growth inflationary policies in the US had started to boost the greenback weeks before the election result was announced. We maintain a target of euro dollar at parity for Q2, that we realize the risk that this target could be achieved a whole lot earlier. Jane joins us now for more. Jane, welcome to the program. I'd love, first of all, your reaction to the story that came from the Washington Post about 45 minutes ago, and I'll share the lead paragraph with you. The President-elect Donald Trump's incoming aides are exploring tariff plans that would be applied to every country, so universal tariff, but, and here's the key but, only to cover critical imports. This according to 3 people familiar with the matter. We've yet to hear, of course, from the incoming president himself on the record, and no doubt we'll hear from him later on today at some point on X or elsewhere on Truth Social. Jane, your reaction to that headline and how dependent your call is for euro dollar to get down to parity on what happens with tariffs?
Well, I mean, there's a couple of different ways to answer that question. I mean, the first thing and most obvious thing is that we don't know what is meant by critical imports. Is this food? Is this pharmaceutical goods, etc., and maybe a whole lot more. So it adds in a way to the uncertainties that we have. We've all been uncertain about the tariffs, how many or how much of the tariffs would go through. You know, how much of this was a negotiation ploy, which countries would be affected first. All of these uncertainties have been out there for quite some time, and this just puts perhaps a different slant on some of those uncertainties. But you know, we still have the basic uncertainties about when is this going to happen, how soon is it going to happen, how much of these tariffs are going to be, and I imagine a lot of those uncertainties are going to be in place to some degree or another, you know, for some months. But although, you know, tariffs are seen as a strong dollar policy and an instrumental part of that because of the inflation that they would bring to the US, we've also got to look at euro dollar, the other side of the coin, that the euro in isolation. And I would say that this is, or the story of parity is in part because of the weakness of the euro. And I've been saying, you know, for a long time, through large parts of last year, that the resilience of the euro, certainly through the first half of last year, was, I think, one of the biggest unsung stories of FX in 2024. Now, the euro buckled in the last quarter. It gave away, excuse me, some ground. And And that, I think, is because the market recognized that the ECB had turned a hell of a lot dovish, and it took away the protection that the euro had and really opened it to the issues of the structural issues that, for instance, Germany has, France's budget issues, and actually the deep ingrained political problems that Italy has, and that's been demonstrated perhaps over the weekend by the collapse of the coalition talks in Austria, which do have parallels with what's going on in Germany and France too.
Jane, what I'm hearing from you is that to get to parity, it's actually more about European weakness than the dollar strength. When do you think we can actually see euro-dollar hit parity?
Well, I mean, to be honest, I think it's a story of both halves. I think we just need to look at the euro story as well as that story of dollar strength, which, is a fairly universal story. But the euro story is very important. Now, our official call is in the second quarter of this year, so anytime, between March and June. But look at the way that the euro or euro dollar has performed, over the Christmas break, over the last quarter. In fact, if we look over the last quarter, the euro hasn't been the worst performer. Various other G10 currencies have underperformed the euro, but the fact that we are so close to parity perhaps draws our attention to the weakness of the euro and the strength of the dollar versus the euro. Now, I do think that it could happen, certainly by around March, but I think for that to happen, we would have to be sure that inflation is or has become a lot more benign in the Eurozone. And we do, of course, have key CPI data this week for the Eurozone. If that is the case, that the market will retain this view that the ECB has turned a lot more dovish, and I think that can really continue to expose the euro to Europe's political and Germany's structural issues.
Which raises this question, Jane. Let's say natural gas prices go up, making the whole disinflation story more complicated for the ECB. Is that good or bad for the euro?
Well, if the market has already priced in an awful lot of easing for the ECB, so from that point of view, you could already argue that there's enough ammunition, perhaps, for some pullbacks in euro, and certainly we're seeing a little bit of that today. If there was more inflation there, the market would have to take out some of that pricing in of rate cuts in the ECB, and that could strengthen the euro. And that's why we're not actually calling a move below parity, at least not in this moment, because, we've heard from Lagarde, they're nearly there in terms of the battle against inflation in Europe, but just not quite. And there are still those resilient uncertainties about inflation that we need to get through first. And only, I think, if that happens, can we start to talk, very seriously about a sustained move below parity.
Jane, how much control does the European continent have over its own destiny at the moment?
Well, at the moment, we're lacking strong leadership in many parts of Europe. So, it's certainly reduced. I mean, clearly, tariffs is a big threat to European trade. And therefore, we have strong leadership in the US in the form of Trump and his tariffs. Very weak leadership in Germany. Very weak leadership in France. And this weekend, no real leadership in Austria too, and that's a concern. For instance, the far right in Austria is pro-Russia. We've got the Ukraine war, of course, on the doorstep in Europe at a time where Trump is putting extra question marks about NATO, where Europe is on the back foot trying to catch up in terms of spending on defence at times where its budgets are very stressed. So this is a time when Europe really could do with strong leadership, and it doesn't really have it. So it is a risk factor, and I think it's a risk factor for confidence in the Euro project and therefore the Euro.
Jane, appreciate your time, as always. Jane Foley there of Rabobank. Out of the City of London, euro-dollar 104.20. Talked a lot about this over the last month or so, how little needs to go right to engineer big moves in a currency. And when we talk about how little needs to go right, just a little story out of the Washington Post suggesting that maybe, with a big maybe, some of these tariff efforts get watered down.
Yeah, basically get ready for the next couple of months, because this probably is a preview.
104.20 on euro-dollar. Up next in the second hour of Bloomberg Surveillance, we'll catch up with Dan Greenhouse of Solace Alternative Asset Management, Henry Trays of Veda Partners, the former World Bank President David Malpass, and Jim Bianco of Bianco Research.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
On the fixed income side, we still see a lot of challenges.
We've come into this year with no bond bulls.
My friends, the bond vigilantes are acting up again.
There's a big divergence right now between disappointing economic data coming in and the 10-year Treasury yield moving higher.
I think we're actually going to see a year where the data plays an even bigger role.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Check out the equity market, looking for 2 days of gains on the S&P 500, higher by 0.75% on the S&P. On the Nasdaq 100, up by a little bit more than that, up by 1 full percentage point. The headline of the bond market earlier on in the session came from the long end of the yield curve. The 30-year yield briefly, the highest since 2023. Yield since then declining just a touch. We're down by a single basis point on a 10-year maturity. The big moves in the last 60 minutes or so, right here in foreign exchange. The dollar is weaker. You are seeing a stronger euro, a stronger Mexican peso, a stronger Chinese currency as well, off the back of this headline from the Washington Post that President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country but only cover critical imports.
The hope being baked into the equity, into the foreign exchange market, is that this means a more tempered and targeted approach from the Trump administration. When you take a step back, the bigger takeaway to me is just how much of a move we saw on this headline about what even is being considered, not even necessarily that's going into proposal before we even get to January 20th.
Well, as Jonathan said earlier, though, the market has pretty much priced in the day after the election, or even actually weeks before the election, a Trump administration. And I think what the market is picking up on the fact that this might not be the universal tariffs and the ring around the wall of the United States that he was promising. And if it is more narrow, then that is great for other countries. But as Leland Miller said, this is the sausage making in real time. And we just don't know yet exactly what their incoming president is going to decide on.
No final decision has been made. I don't know what critical imports are. Critical imports to who? That's kind of important at this point. That might be rather subjective to the incoming administration, so I'll leave that one there. But put it all together, this morning is pretty bullish. You've got them talking about one big bill passing by April for Republicans down in Washington, D.C. At the same time, you've got a report from the Washington Post that maybe the universal tariff effort will be diluted. Is it any wonder that equities are up again this morning by the amount they are?
Bullish for equities. And I think that this is sort of the key tension right now. All of that is very bullish for equities, especially because of the implicit message from this super bill, this very big, beautiful bill that would get passed, is deficit expansion. And this question about how much debt would have to get issued ahead of a week where we have $119 billion of issuance, including 30-year notes on Wednesday. A real question here about how much a check the bond market will be on this sort of everything is fantastic move that we've gotten in equity markets until the end of last year.
Terry Haynes says 2025, the bond market has a voice, and they may be the ones that are going to decide the size of the deficit. And Terry Haynes, even though Donald Trump is saying in black or white it's going to be one powerful bill, he's saying potentially it might end up being two reconciliation bills. Again, the sausage is being made in real time. We definitely have some markers in the sand, but right now, we still don't know for sure.
Off the back of those headlines from the Washington Post, bond yields down at the front end just a little bit, to your yield down by 3 basis points, and a dollar weaker against pretty much everything in G10. Big lineup this hour. Coming up, we'll catch up with Dan Greenhouse of Solace Alternative Asset Management as stocks look to build on Friday's gains. Henry Trays of Vader Partners on President-elect Donald Trump's expensive agenda, and former World Bank President David Malpass on how Congress can fix what he calls the fake debt limit. We begin this hour with stocks rising to start the first full trading week of the new year. Investors piling into tech stocks over the last 12 months. Dan Greenhouse of Solace weighing in, saying Nvidia and AI are still the dominant story, given the size of those companies, and the single biggest risk is the same as it was in 2024. Some disappointment or demand slowdown for this story. Dan joins us now for more. Dan, Happy New Year.
And Happy New Year to you, sir.
Good morning. Good to see you.
Good to be seen.
Is this more important than maybe what's going to happen down in Washington, D.C.?
Nvidia? Yeah, I think so. I mean, listen, this is not to dismiss other risks, particularly on the rates front, the tariff story, another coronavirus pandemic. I mean, there's always things about which we should worry. I just think given how much the broader equity markets are being driven by that AI story, not just in the chip names, NVIDIA, Broadcom, et cetera, but in the derivative plays, the industrial names that are building it out, the HVAC names, the rack companies. It permeates so many different parts of the market. I think if there was some material slowdown there, it outweighs the other risks.
Do you just assume that underlying growth with all that going on is going to be okay? Things are going to be okay?
Well, that's obviously separate from the economy. And yes, I think the GDP seems to be doing fine. I think we're talking about somewhere around 2.5% for the fourth quarter, somewhere around 2.5% for the year 2025. Whether it's 2.7 or 2.3, I think is largely irrelevant to the market. But from an economic standpoint, at least right now, what derails that, I'm not quite sure.
So basically, you're watching Huang Jensen, you're feeling pretty good, and you don't really care about bond yields.
No, it's not that I don't care about bond yields, but I think well, wait, I didn't say that.
Well, I guess I'm wondering. I mean, the big sort of sticking point here is good economy, everything's fine, and then there's this real anxiety creeping into the bond market. Okay, everything's fine because of fiscal expansion ongoing, as well as this idea that maybe inflation's not going to be killed by rates where they are. At what point does that become the fly in the ointment for you?
So the inflation's not going to be killed by rates where they are. Listen, inflation has normalized. Is it at 2%? No. As an economist, am I disappointed in that? Sure, although I'm not an economist. But if I were, would I be disappointed in that? Yes. But as an investor, which I am, whether it's 2 or 3% is largely irrelevant to me. Obviously, that matters in the context of policymaking and how that impacts the market. But from a broad market standpoint, 3% inflation is not particularly deleterious. And as we've seen over the last 2 years, the equity market, largely speaking, doesn't care. With respect to yields, listen, break-evens are basically unchanged. I don't think there's any, at least from an evidentiary standpoint, I don't think there is any explosion of inflation concerns. I think certainly the risk is that we don't get back, the consensus now agrees that we don't get back to 2% relatively quickly. But I would add, and the point I was building up towards, is the Fed told me that 2 years ago. They said 2 years ago that inflation was not going to get back to 2% until 2026. Now it's 2027. And they were not willing to do the work on rates to get it back there sooner. And so as an investor, I'm left with inflation normalizing, not as quickly as thought, and a Fed that's not stepping on the brake as quickly as they think they need to, and that's positive for risk assets, and I think that stays in place for now.
That's positive for risk assets. When you overlay that, though, with policy prescription from Washington, D.C., that by all accounts will probably increase the deficit by anywhere from $1 to $5 trillion, and even upwards of that, at what point do you start to worry about real yields, about when you strip out inflation expectations, this idea that bond vigilantes are back having a voice at the table and they're not happy?
I don't think you meant to do this, but I take issue with it. The extension of the tax cuts will not increase the deficit. It's going to increase the debt over the 10-year period. It's going to cost $5 trillion in the out year. But I think most assumptions take into account that the tax cuts are going to be extended here in the short term. That said, 7% deficit to GDP ratio is just astronomically high, unacceptably high, and to use a scientific word, gross. But that's getting done. The tax cuts are getting done. It's not like the bond market's going to be surprised when we pass that reconciliation bill, either the first or second later this year, and we know the Penn Wharton, we know all the private estimates are somewhere in the $3 to $5 trillion range. I don't think that's a surprise to market, I guess, is the point that I'm making. With respect to yields, yeah, like we've clearly seen risk assets struggle when the 10-year gets up into the 4.75 to 5% range. We're obviously not quite there, although equities are already wobbling. If we were to move higher, again, I think that's probably going to elicit some type of response, but the push-pull in markets is going to be, you're going to see thereafter, perhaps, probably, yields start to come back down from that level for whatever reason. There are numerous ones we can discuss, and that'll eventually, as long as the economy is doing fine and earnings are doing fine, which I think is your baseline, a resumption of that upward move.
How are you thinking about tariffs when last night President-elect Trump said that one powerful bill is going to be paid for mostly by tariffs, and this morning the Washington Post says, well, it's going to be narrow, targeted tariffs on critical imports?
John, I think, put it perfectly at the start. We're watching the sausage get made, and I don't think any of us know, I'm not even sure the administration knows, what the final set of tariffs are going to look like on who. John made the most important point. What's a critical material? One person's critical material is another person's industrial input. So I don't know how to model or how to think about this because I don't know on whom, by how much, for how long. And alternatively, I don't know who is already circumventing the supply chain. We put tariffs on China. What good does that do me if I ship my goods to Vietnam and then ship it out of there? And we've seen this where our imported goods from China is lower today than it was 5 years ago. But look at our imports from Vietnam, Malaysia, Indonesia, et cetera, they're all higher. So this is a series of whack-a-moles here. That said, one big, beautiful bill, he can say that. I think, as you know, Congress probably is going to disagree with that.
But when you put all of this together, what is your base case for what actually does get done in 2025?
On tariffs?
On tariffs, on the corporate tax rate, on immigration policy?
I don't see any. Okay. My personal opinion, I don't see any way the corporate tax rate is lowered any further. I would be shocked if it's lowered by any amount, 1 percentage point. I don't think there's stomach there on the Hill, and you know better than me, but I don't think there's stomach on the Hill for the no tax on tips, et cetera, et cetera. I just don't think there's room in the budget for them to do that, and I don't think they will. Obviously, the TCJA is going to be extended. Those tax cuts will be extended, but I don't think any new tax cuts will be applied. On the immigration front, I'm less concerned about this from a market standpoint than some other people. Housing, obviously, and industries, leisure, hospitality, et cetera, that disproportionately rely on imported, undocumented, or illegal immigration are going to be hurt. But I don't know that it's the broad inflation disaster that some people are making it out to be. So that's my working view of things. I think, listen, from an investor standpoint, we're looking at companies that are doing quite well, that have clean balance sheets, that have good thematic stories, et cetera, et cetera. the stuff that we're talking about is all super important for the broader market and the risk landscape in general. But from an individual company standpoint, most companies are immune. Most companies are immune. Not all, but most companies are immune.
When you find those companies that you like, you're more comfortable taking equity risk or credit risk? Where do you find the bigger opportunity set right now? In fixed income or in equity markets?
Probably in equity. And you've asked me that question intermittently over the last year,
Yep.
and I've said credit at points. I think right now, the problem with the credit market is in the last, not the problem is not the right word, but the issue that you have in the credit market right now is the lower rated credits where you might get a much more attractive yield, 13, 14%, have experienced a tremendous rally over the last couple of months. And so the yield on the CCC index now, and I've said this 100 times, it bears repeating, CCCs are just a group of companies. They're not really an index, but CCCs are yielding somewhere around 10% right now, 400 basis points lower than a couple of months ago. And so a lot of that attractiveness has come out of the market, and as you saw in the equity market with the big rally. So I think if you're going to get paid, you're taking effectively equity-like risk in those in some of those lower-rated credits, in which case you might as well get the potential of equity-like returns by taking that equity risk in the equity market. And so on balance, I think we're seeing probably more opportunities in the equity market right now, but that's not to say there's nothing to do in credit. I just think on balance, you're probably getting paid more in the equity market.
Equities up this morning by 0.7%. Dan, it's good to see you.
Always my pleasure, guys.
Thank you, sir. Dan Greenhouse there of Solace Alternative Asset Management. I want to bring you this headline, widely expected. It comes from Nippon Steel and US Steel filing lawsuits on their deal and calling it deal interference.
And what they're talking about is the interference from the President of the United States, Joe Biden, and the debate that really took place in the West Wing on whether or not to talk about domestic political concerns versus is this real a national security concern, given the fact that Japan is an ally. So we have that now as a lawsuit, and then tomorrow we should also be hearing from Nippon Steel.
We talked about this last week, closing a chapter on all of this. We're not closing a chapter on anything, can we?
No, and it sounds like the Japanese government is going to back Nippon Steel with respect to their lawsuit against the U.S. and saying that essentially this really undermines the alliance between the two. So get ready for a lot more of the same.
It's not going away. Let's get you the latest elsewhere. With your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. A new report last hour from the Washington Post suggests that President-elect Donald Trump is exploring a universal tariff, but one that would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plans to impose the duties on every country. It would, though, be a paring back of the most sweeping plans from Trump's 2024 presidential campaign, where he called for tariffs as high as 10 or 20% on everything imported to the U.S. United Airlines expects to begin using SpaceX's Starlink for in-flight Wi-Fi in the spring. That's an earlier than expected rollout. United said in a statement on Sunday that only members of the carrier's loyalty program will get the service for free. It marks a departure from the original plan, which would offer all passengers the service free of charge. And the U.S. are United Cup champions once again after Coco Gauff and Taylor Fritz took down their opponents from Poland in the tennis tournament. Gauff took down world number 2 Iga Swiatek in straight sets despite winning just 3 of her previous 13 matchups against her, with number 4 ranked Fritz beating his opponent in a tiebreaker in the men's singles. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, Donald Trump's expensive agenda.
I am still shocked that I don't think that the market fully has embraced how much deficit spending I think we're about to do.
That conversation up next. Live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
Equity futures right now on the S&P 500 up by 0.7%. We've got some big moves to talk about in foreign exchange. Euro dollar back at 104. 104.16, up by 1 full percentage point. I get it. Not much needs to go right in Europe to engineer a big rally, given the sell-off that we've seen. But this came from the Washington Post a little bit earlier this morning. That President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country, but only cover critical imports. Now, I've got more questions than answers right now, but certainly the move speaks for itself, Lisa. It's a sell-off in the US dollar.
And you say this has to do with not much has to go right for the Eurozone, but you also see a similar sized move in the Mexican peso. So to your point, this is broad-based and showing the volatility and sort of the expectations baked in about tariffs and what we'd have to see to ignite a whole lot of volatility in some of these basic currency pairs.
Just waiting for that headline, that post from the incoming president, when he finally gets to read this later on this morning, and an aide just sort of pushes the story over and says, what do you think?
Yeah, he'll say critical infrastructure is absolutely everything under the sun because basically everything that you import is critical to us. So, you know, good morning.
Or when we get the hearings from Jameson Greer and Howard Lutnick, when they start talking again about broad-based tariffs, this is as Leland Millen put it, sausage being made. You're going to see the debate, as we saw during Trump 1.0, played out very much so in public.
Looking forward to another 4 years of this. This is the latest this morning. Before we even get started, inauguration, January 20th. At the surveillance this morning, Donald Trump's expensive agenda.
I am still shocked that I don't think that the market fully has embraced how much deficit spending I think we're about to do. I think that we're going to have $6 to $7 trillion in deficit finance spending come out of this Congress.
So here's the latest this morning. President-elect Donald Trump sharing that the Republican-controlled Congress is working on one powerful bill that will bring our country back, adding the bill will focus on the border, energy, and tax cuts. Henrietta Trays of Veda Partners warming to prepare for a giant deficit number, writing, we expect federal spending to rise at least on pace with inflation. The main takeaway is that total deficit increases incurred by legislation passed in 25 could easily exceed $5 trillion. Henrietta joins us now for more. Now, Henrietta, as you know, 5 sounds like a big number, but for many, that's just a baseline. You extend TCJA and you're talking about 4 to 5 trillion. So upwards of what? How big could that number be?
Yeah, I mean, to get to your point from the earlier conversation, this is absolutely deficit increasing spending. The reason the tax cuts expired at all is because in 2017, $1.5 trillion was the deficit authorization. That was used and thoroughly exhausted, and now we have to do it again. So this is 100% adding to the deficit beyond what is the existing baseline. So extending the TCJA is $4.6 trillion. That does not take into account the fact that they do not have the votes to maintain the SALT cap at $10,000. That's your single largest revenue raiser at $1.2 trillion. And if you have to raise that to $20K, which would eliminate the marriage penalty as they describe it, or even further beyond that to get those 18 SALT caucus members, you're going to make the bill even more costly. Then I think you're also going to run into issues with repealing the Inflation Reduction Act. Those energy tax credits disproportionately go to red states and job creation in red states, and Republicans are going to have a hard time voting for those as well. So there's really no pay-fors. The tariffs, of course, will not be voted on by Congress, and so they will not be included in the score that we get for the tax bill. This is going to be a massively deficit increasing number that we see just from this one reconciliation bill, before we even take into account the military spending of at least $200 billion and more besides.
Henrietta, we haven't even got to the point that President-elect Trump also gave a shout out to extending the tax cuts and talking about one campaign promise that even Democrats welcomed, which is no tax on tips. Do you actually think that gets done?
No, definitely not, because of the problems that it incurs for Social Security and Medicare, spending from which the payroll tax and other taxes goes towards funding. So
but hold on, why is he then putting it in black and white if there's no appetite on Capitol Hill?
Because I think he's not in Congress yet. He's saying a lot of things that are going to be really difficult to get through, such as reducing the corporate rate to 15%, which is a non-starter as well. When I talk to Republican staff, they say, we don't really have any interest in reducing the corporate tax rate. And that's very much what you hear behind the scenes on no taxes on tips. It just doesn't have support on Capitol Hill. It's really a giveaway to Nevada is the way a lot of members think about it. And of course, those are only 2 senators.
So Henrietta, who is the voice that we should be paying attention to? Is it the Trump tweets? Is it Speaker Johnson? Or is it incoming Senate Majority Leader John Thune?
I think that you should definitely focus on the House and Senate members, as the president does not have the authority to write tax legislation. So it's Jason Smith in the House Ways and Means Committee, Mike Crapo at Senate Finance. Those are the 2 senators, 2 members who are going to be working on writing the details of this bill. But more importantly, think about the members who are up in 2026. That is, of course, every single House member, but then some really key senators like Tom Tillis in North Carolina, Susan Collins in Maine. Those are going to be your linchpin deciders, especially when it comes to any spending cuts that they might want to see. Those members are going to be the ones who say, hold the phone, we're not ready to take those cuts yet.
How powerful, Henrietta, are the members going to be sitting behind their Bloomberg terminals trading 10-year notes?
I think that is definitely the least powerful member in the room. Not a lot of senators or congressmen are necessarily focused on what the market does. I know there's a perception that Trump cares very deeply about what the market does on a day-to-day basis, but look at what really happens. Lawmakers are going to write the legislation that they see fit, and the deficit spending continues to rise every single year. We're talking now about roughly $5 trillion in spending just in 2025 alone on a combination of this tax bill, keeping the government open, hiking the debt ceiling by another $1.5 trillion, et cetera. It's not going to factor in. They will be increasing the deficit.
Henrietta, there's a larger question here, though. If that member doesn't necessarily have the same clout, how much the deficit increases just by virtue of how much yields have risen? Yields have risen some 70 basis points last year. On the 10-year, they're continuing to rise into 2025. At what point does that become a limiting feature in terms of what they can do just simply because that rate alone expands the deficit?
I just don't see it really having an impact in D.C. It's definitely a conversation in boardrooms in New York and on Wall Street. But when you go to D.C., they talk about the near and present danger of the expiring tax cuts, about the potential for default, about the need to keep the government open. There's not a break on federal spending when there's a to-do list. And this is the 1 year that Republicans have majority control over all 3 chambers, and they have a massive to-do list. They have to get it all done this year. And what will happen is what usually happens. As we get closer to a midterm election cycle, everybody starts to clutch their pearls again. So we'll have a conversation around reducing federal spending, reining in the debt, talking about interest in 2026. The DOGE, or the Department of Government Efficiency provisions, are expected on July 4th, 2026. That's 4 months before the midterm elections. There's no scenario where we cut the deficit by trillions of dollars 4 months before a midterm. It's just not realistic to anticipate politically. So you'll hear the conversation start in 2026, but in the immediate term, 2025 is all about spending.
Henrietta, appreciate your time, as always. Henrietta Trays there of Vader Partners on the latest. Are we 50 basis points away from a different conversation? 100 basis points away from a different conversation? How much higher do bond yields need to be?
Honestly, she was saying that's not really the focus in Washington, D.C. At a certain point, though, it has to become, because it adds to the deficit and reduces how much they can spend. And frankly, it comes under this question of the debt ceiling and a whole host of other issues. But it's a good question. At what point do the debt vigilantes get the main seat at the table?
David Malpass, the former World Bank president, joining us shortly with this to say recently in a Wall Street Journal op-ed, saying the outgoing government is leaving a tailor-made debt crisis for Mr. Trump. That conversation just around the corner. If you are just joining us, equities near session highs of 0.75% on the S&P 500. Bond yields a little bit lower. The dollar weaker, euro stronger, euro dollar 104. That currency pair positive by 0.9%.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest makers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Equities close to session highs, up by 0.7% on the S&P 500. On the Nasdaq 100, up by 1 full percentage point. We're 2 hours away from the opening bell with your morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. It was the Mag 7 that had a revivalist movement on Friday, up 2.5%. Kick it off with Boeing this morning. Barclays has decided to go overweight. So this is the first time they've turned bullish on this stock since 2019. They've upgraded the stock price to $210, so a considerable uplift from here. The original target price was $190. Why? Why turn positive for the first time since 2019? They shored up the balance sheet, and it is no longer an overhang. Sustained positive momentum for production and deliveries, and this is critical to the story of Boeing. What are they going to reset the max production to? Where do we get to in 2025? Stock is bid this morning. NVIDIA, I talked about the Mag 7. We're up 2.67% this morning. Add on your 4.5% bump that you had on Friday. That gives you nearly 7% in the space of 2 days. Honhai, our Foxconn, has seen a 15% jump in their revenue. So that's emboldened the story. Microsoft coming out and saying, we're going to spend $80 billion in the fiscal year coming. Last year in the fiscal year, they spent $50 billion. So that mega capex story remains. And it is emboldened again at Microsoft. $80 billion for the fiscal year. I'll leave you with a snapshot of GM. The deliveries in China jumped by 40% quarter on quarter, 600,000 units there. In China, in the complete year 2024, they sold 1.8 million vehicles. 50% of those sales in China were in the EV space, and half of their annual sales were in that. Just a fact for the day. Here in the United States of America, Toyota sold nearly 1 million EVs, hybrids and EVs last year. This company sold 114,000, and they don't have a hybrid. Go figure.
Manus Cranny, thank you, sir. Stock up nicely in the pre-market by 2.5%. Lots of news to get through. Under surveillance this morning, Secretary of State Antony Blinken hoping to broker a ceasefire deal in Gaza before the end of the Biden administration. Blinken telling reporters, quote, "We very much want to bring this over the finish line in the next 2 weeks." Elsewhere, New York City drivers now paying up to $9 to enter the busiest part of Manhattan. Today marking the first regular weekday under the country's first congestion pricing program. President-elect Donald Trump and Governor Phil Murphy of New Jersey still vowing to fight the toll. Our very own co-host from Queens with some strong feelings on the matter.
Well, Trump has called it a regressive tax. What I have heard officials talk about really for years that are on the outer boroughs, and as they say that their constituents that have to go into Manhattan that have no choice but to take their car, this is going to hurt them the most. The MTA is desperate, it needs money, but many say, is this really the best way to fund it, especially when more people have a lot of anxiety these days about getting on the subway due to safety concerns?
There's a little bit of what comes first, the chicken or the egg, right? You can say it spends too much money, it's badly managed in terms of the MTA and the subway system, but if they need more money to make it safer, to make it a better option, to make it faster for people to be able to go in, then how are they going to do that at a time when the federal government isn't going to do that? So ultimately, that is the question, how you do that, how you sort of thread this needle. Good luck.
Can I address a myth that is going around Europe? There is a story that they believe.
Yes.
The story that Europeans believe is that Americans don't really pay taxes. and they come to places like New York and they see the infrastructure and they're like, they need to start paying taxes to invest in the infrastructure, to make things safer, make things run better. We pay taxes, lots and lots of taxes, believe me. It's how they spend the money and how much money is being wasted that I think speaks to what's happening right now with the incoming administration and Elon Musk. Do we really need to give them more money, or do they need to spend the money they're getting more efficiently?
Again, and I would agree with that. Can you do both at a time where they need signal repairs? I mean, this weekend you saw all the subways shut down on certain lines because they had to repair signals that last were put in place in 1967. So here's the question. At what point do you incentivize the political will to be more efficient by actually charging money to people that suddenly care about where that money is going? I mean, this is a larger question about how politics is run, and I am not the person to have it, but I will say it is an important one to be had.
But John, to your point, if you're a New Yorker, you're paying federal tax, you're paying state tax, and you're paying an extra city tax. I also lived in London, where I paid a ton of tax, similar to actually what you end up paying when you put it all together in New York, yet you saw your money put to work. Never felt unsafe taking the underground. Never felt unsafe really walking around the city. Never saw garbage on the streets. Very different in terms of how they use the money and where the tax money is being spent.
This debate's not going away, and we can have it another day. I need to turn to this, the weather. It's freezing outside. A major winter storm making its way across the United States. Millions of people bracing for a mix of snow, freezing rain and sleet as the day begins, with more than 60 million people under winter alerts nationwide. Alex De Silva of AccuWeather joins us now with the latest. Alex, is it as bad as people feared?
Yeah, it certainly is, and it's a very widespread storm we're dealing with right now, stretching anywhere from the center of the country all the way to the East Coast. We've seen reports 6 to 12, even 18 inches of snow back across Kansas and Missouri, with up to 3/4 of an inch of freezing rain. Down trees, power lines across Missouri, Kansas, and into Kentucky as well. But where's the snow now? It's heading towards the big cities. Right now, Baltimore, Washington, D.C., right around 4, 5, 6 inches of snow right now, and a couple more inches will be on the way throughout the day today, as well as some freezing rain down here. What we got to watch out, Richmond, Roanoke, they could pick up maybe 1/10 to 1/4 of an inch of freezing rain in some of these areas as well.
Alex, I've got a New York bias. When do I need to call in sick? Thursday? Friday?
Yeah, well, New York City, we're keeping a close eye out for. I think the snow probably gets there sometime this afternoon, late morning into the afternoon. Doesn't look like a whole lot, maybe a coating to 1/2 inch, maybe up to an inch, but I think most of the heavier snow will be off to their south.
Got it. Alex, thank you. Appreciate the update. We'll get an update from Alex tomorrow as well, I hope. Alex De Silva of AccuWeather.
So 1 inch, you call it out with the flu?
Yeah, you know, that's a very British thing to do. 1 inch of snow, it's just like...
It's also what they do in Washington, D.C.
Maybe they don't know how to handle it there, but I would hope that we could do better than that.
In Washington, D.C., this is actually a huge problem. They don't have the infrastructure set up to clean the streets. Everyone freaks out when it snows, although someone did send me a message today saying the news is not actually matching what I'm visually seeing outside my window this morning.
We slated the subway system in New York City a little bit earlier. Can I just say, when it snows in Manhattan, it's pretty impressive how quickly things go around and... clean up pretty fast.
Wait, hold on a second. This is impressive. Saying something just, nice about the subway.
Not the subway. I just mean
street clearing.
Street clearing.
Okay, well, you know, both. It's the fastest way to get around when it snows, just say.
Let's turn to politics. President-elect Donald Trump calling for the debt limit to be abolished before he returns to the White House on January 20th. The former World Bank President David Malpass, writing in a Wall Street Journal op-ed, President-elect Trump was right last week when he raised a red flag over the debt limit. The outgoing government is leaving a tailor-made debt crisis for Mr. Trump that complicates his work to implement his mandate, cut taxes quickly, and rebuild U.S. strength. David joins us now for more. David, welcome to the show, sir. It's always good to catch up with you. I just want to address that one line in the op-ed, a tailor-made debt crisis. Can you just explain that a little bit more?
That's right. This has been coming on for a year, for 2 years. They kind of planned it so that the new president, the next president, would have the problem. So Congress spent all the money, and so it's tailor-made for a crisis, because if you don't raise the debt ceiling, you have a default on the national debt. What I've wanted them to consider is rewriting the debt limit so that it actually works. You've got to stop the spending before it happens rather than after you've already spent it.
David, we heard over the weekend from Mike Johnson, House Speaker, that there's going to be one big, beautiful bill, and it's going to probably come in April, and it will be put through by reconciliation to get all of Donald Trump's agendas in place. We were speaking with Henrietta Trays. She said this could expand the deficit by some $5 trillion. Do you think there is the will to start to revise the debt ceiling debate and some of these other issues to structurally reduce the deficit under the Trump administration?
I think there's a strong will to reduce spending. One of the things going on is Biden is leaving the cupboard bare as he leaves office. That means they've spent up as much as they can on the current fiscal year. They're in the process of obligating every day that goes by, that they're obligating huge amounts of money that can't be gotten back through the rescission process. So if you make a grant and you obligate the funds, you can't get them back. And then another way that the cupboard is bare, and it's showing up in the bond market, is they've kept the issuance of debt short term. So one of the biggest decisions facing the new administration will be what maturity to issue at, and does the Federal Reserve buy back all the long-term debt? You know, the Fed is this giant hedge fund. It's owning all of the long maturity, or a big chunk of the long maturity bonds. So I think over the last 3 months, they've lost maybe $650 billion just on having a bad bond trade. You know, yields have gone up. So they're the big holder of long-term yields. So the consumer feels okay, but the government itself is losing massive amounts of money until they find a way to slow down the spending machine.
Do you think, just to sort of build on that, David, that the reason why we've seen that rise in longer-term yields is because of the deficit? Is this truly the bond vigilantes coming back to the table?
There's some of that. The market looks ahead and says, do you have a mechanism to actually control yourself? And so the bond yields are having multiple problems. One is the Fed's models are really broken. So the Fed is basically saying, if you have more growth in the economy, we assume it will be inflationary, and so we will have higher interest rates. So it's a broken models problem. But then second, as I mentioned, the duration of the government was held down. The Fed was buying, the Treasury issued some long-term treasuries, but then the Fed bought them back. And so this is a major problem because you have to get over the hump. You can do that through confidence, and that means, are you able to repeatably, over and over again, cut spending? Do you have a mechanism to actually control what Washington spends? That's yet to be seen, but I think they can do it.
David, I don't really see any restraint right now with the incoming Trump administration. President Trump talked about yesterday one powerful bill, border security, energy policies, renewing Trump-era tax cuts, except making them better to include no tax on tips. And we're talking about a president who spent $8 trillion or added $8 trillion to the deficit during Trump 1.0. So where do you see the appetite of Trump to want to cut spending?
It's going to be a combination of increasing growth and production within the economy and making the existing spending more efficient. So if you get more from it and you have fewer people but fewer obligated funds, that's going to be the trick. I want to really put emphasis on this idea of markets being forward-looking and looking at the output of the economy. If you can change the energy system, that means both the production but also the transmission of energy. That's going to have a big downward effect on inflation. The Fed doesn't have that in its models. Each of the Fed's models are broken. One is on how you set interest rates. One is how you use the balance sheet. They've used it very harmfully in terms of the lost money. And then third is their regulatory policy. The Fed has this massive control over lending to small businesses, and that hasn't been going well, but that can be repaired and fixed. You get more output, less inflation, and you can bring interest rates and bond yields down.
Something you've talked about a few times, David. We'll have this conversation again in the near future, I'm sure. David Malpass there, the former World Bank president. In the bond market, bond yields a little bit lower at the front end of the curve. We're down 3 basis points on a 2-year, 425. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Joe Biden said that he's determined to peacefully hand over power later this month. Writing in a Washington Post op-ed published last night, Biden said he's, quote, determined to do everything I can to respect the peaceful transfer of power and restore the traditions we have long respected in America. Adding, I have invited the incoming president to the White House on the morning of January 20th, and I will be present for his inauguration in the afternoon. Meanwhile, shares of U.S. Steel are higher in the pre-market, nearly 5%. According to a statement from Nippon Steel and U.S. Steel, the two jointly filed lawsuits to remedy the interference with Nippon acquisition of the U.S. company. The companies say that they are confident that they have, quote, strong cases and will rightfully close the transaction. The New England Patriots have fired head coach Jared Mayo on Sunday after they went 4-13 in his first season as an NFL head coach. The move came soon after their season-ending victory over the visiting Buffalo Bills, which ended up costing them the top pick in this year's draft. The 38-year-old Mayo played linebacker for the Pats from 2008 to 2015. His one-year stint as head coach ties for the shortest in franchise history. And that's your brief, John.
Danny, thank you. Appreciate it. Up next on the program, the Fed's data dependence.
I think we're actually going to see a year where the data plays an even bigger role, and we already know that that can create a lot of unnecessary volatility because it's hard to measure a $30 trillion economy in real time with a lot of accuracy.
That conversation up next. We'll catch up with Jim Bianco of Bianco Research, live from New York. You're watching Bloomberg TV.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Another leg higher for stocks. On the equity benchmark, the S&P 500 up now by 0.8%. We're down by about 2 basis points on a 10-year, 457.74. Under surveillance this morning, the Fed's data dependence.
I think we're actually going to see a year where the data plays an even bigger role, and we already know that that can create a lot of unnecessary volatility because it's hard to measure a $30 trillion economy in real time with a lot of accuracy. Part of the Fed's job is to help turn the lights on and at least chart a path. I don't think things are as calm in the labor market as the Fed kind of in their latest projection seems to view it.
Well, here's the latest this morning. Both San Francisco Fed President Mary Daly and Governor Adriana Kugler speaking over the weekend, saying the central bank must reach its 2% inflation target. We've got a full slate of Fed speak on tap this week. We'll hear from Barkin, Waller, Harker, Schmidt and Bowman and get minutes from the Fed's December meeting. Jim Bianco of Bianco Research joins us now for more. Jim, welcome to the program and Happy New Year, sir. As you think about the risks for 2025, how do you see things? Is the bigger risk an employment stumble or the bigger risk a reacceleration in inflation?
Oh, I think the bigger risk is reacceleration, not only of inflation, but of the economy, too. We've been seeing the economy. Economists like a term called potential growth, which is not measurable, but what do they think the economy would grow if we're not stimulating it or slowing it down? And that's about 2.5%. 8 of the last 10 quarters, the economy has grown at least at that level, and it's looking like it might do it again in the fourth quarter once we get those numbers at the end of the month. Add into that the inflation rate is not getting to 2%. There is an argument to be made that it is stalling it around, the high twos if you measure it by CPI, because we're at the same levels on year-over-year CPI that we were 7 months ago. And all of this is just suggesting that the acceleration story is going to be the bigger issue. Now, yeah, there's always concern that the labor market could have problems. But right now, most of the data, whether you're looking at claims or unemployment or payrolls, is not really reflecting that concern, at least not yet.
How much, Jim, does this matter to Jensen Huang? Can Jensen Huang keep on delivering a stock market that gains a little bit even on the margins, even with rates going higher, even with this concern that maybe the Fed was mistaken by cutting rates?
Well, first of all, everybody should care about Jensen Huang because he is the most important person in 2025 to everybody's returns, no matter what market you are investing in right now, because NVIDIA is the driver of everything. As far as he's concerned, it should matter at the margin because it will cost his customers with the ability to buy his products, not necessarily his ability to deliver those products. And that's what we have to be careful of. The AI expansion is going to be unbelievably expensive. The energy needs are going to be very expensive. The power companies that are going to have to power it are going to need to borrow a lot of money. And so it's going to matter whether or not the economy does accelerate and they have to pay higher interest costs in order to finance this AI boom.
I guess the larger question here, Jim, is tech outperformance the only thing that can rescue a market with yields where they are, given how much they climbed last year and how much they continue to climb early this?
Yeah, except if you look at the stock market, what's interesting is that the S&P Friday's close was within 1 point of the close the day after the election. So the S&P hasn't really done a whole lot, since election, other than the initial surge on the day after the election. It's at the same level that it was back then. And why is that? Because I think interest rates are getting in the way, and that we are at levels that are problematic for the stock market. And if we continue to see any kind of growth or any kind of reason to keep these rates up, it's going to continue to get in the way of the story of, higher stock prices in 2025.
Jim, as Speaker Johnson is basically saying we could get this deal done in Washington, one big, beautiful bill by May, would the Fed then wait on the sidelines, potentially see what those policies look like in May?
I hope they don't. Chairman Powell has talked about this concept of fiscal dominance. And, to put it in very simple terms, it's their problem, it's not mine. My problem is employment. My problem is inflation, being Chairman Powell. And I will set policy based on those. If there's a deficit or if there's going to be a bigger deficit or a smaller deficit, we just had an election. It's their problem to deal with. It's not the Fed's problem to try and accommodate higher levels of spending or larger deficits.
But if that is the picture that potentially emerges, does that mean that risk appetite can get worse?
It can. I mean, the thing you have to keep in mind is if you go back to 2019, we used to use the phrase, Tina, there is an alternative. There is an alternative now. There's 5 and 6% yields in the bond market right now. There's a 4.5% effectively risk-free money market rate. So you've got alternatives to the market. Now, I know nobody thinks that those are alternatives because we're all stuck on momentum and that the stock market's at 220% years. So therefore, it must mean we're going to have another 20% year in 25 and probably another one in 26. But actually, the alternatives do exist, and that is going to become, a big hurdle for the market to get over.
Jim, heard a lot of numbers forecasts on a 10-year yield. I mentioned Jordan Rochester and the team over at Mizuho looking for 5. 5 is more likely than 4 on 10s in the US. Academy's Peter Cheer also said he's looking for 475. Nothing about this administration, despite Doge, points to it being fiscally conservative. What kind of numbers, Jim, are you thinking about?
Well, I think that we're going to probably see him take out the October 23 high. That was when we hit 502 on the 10-year note. So I'm thinking 5.5. In other words, a higher high than we saw in 2023 now, 15 months ago. And that will continue the trend that we've seen since 2020, that we're in a secular rise in interest rates. It didn't end 15 months ago. So, I still think we'll probably take out that 5%. And at this point, that's 40 basis points away, maybe 50 basis points away. That's not that far away when you think about the scope of, you got an entire year to potentially reach that target.
Close to 460 this morning, Jim. Appreciate your time. Jim Bianco there of Bianco Research, looking for yields to breach 5%, Bramo, in the next several months through this year.
The level that a lot of people here have said is the danger zone, including Lori Calvasino, in terms of equity returns. You just wonder whether there'll be a response, whether there'll be, as Dan Greenhouse was talking about, the buying mechanism that comes in at 5, or whether people start to get a little bit more concerned.
And is it 5% of the 10-year yield that matters more than Doge? Terry Haynes this morning, bond market may decide the size of the deficit. How much is that going to regulate the same way, Jonathan, you talked about stocks regulating Trump in 1.0?
Lisa mentioned Dan Greenhouse, though. Dan Greenhouse was very quick to say that the biggest risk this year came from NVIDIA. And what you heard there from Jim Bianco, the most important man for the year ahead, not the President of the United States, not Chairman Powell, but Jensen Huang.
Yeah, the rock star who comes in with his leather black jacket. Is that what we hear from Dan? Every time he comes on.
7% of the S&P, and it's like 50% of investor sentiment. We've said that a few times.
Well, especially because this has been the story that has kept and powered this equity rally. It has been the AI transformation. Can it continue to? And does that end up being the haven trade at a time where yields might continue to climb or stay where they are?
I don't want to be all doom and gloom about NVIDIA, but these companies that are tethered to their chips being made in Taiwan, have they really realized what is going on in terms of espionage of China in the United States? And just this morning, Taiwan talking about a Chinese ship breaking a subsea cable. Is anyone in Wall Street going to wake up to the fact that there is actually geopolitical concerns brewing out in the open when it comes to Taiwan and China?
A story from the Journal over the weekend. Pretty concerning, right?
Oh, it actually kept me up at night.
Yeah.
It actually kept me up. I want to know what people are doing about it.
Pretty shocking. Coming up in the third hour of Bloomberg Surveillance, we'll catch up with Liz Young-Thomas of SoFi, the former New York Fed President Bill Dudley, and Michael Capon of Morgan Stanley, alongside Greg Peters of PGIM Fixed Income from New York. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
We just experienced one of the best two-year stretches for markets in history.
All the positive news is priced in.
It's hard for me to be negative U.S. equities.
The U.S. growth situation is in pretty good shape.
I'm looking for a bumpy year, and a lot of those bumps are going to be occurring over the next few months.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The first full trading week of 2025 looks absolutely stacked, and we're hitting the ground running. Buying stocks up 0.75% on the S&P 500, on the Nasdaq up by more than 1 full percentage point. This week, jam-packed, full of economic data and debt sales, and it includes payrolls Friday. The estimate for Friday, 160K. The previous number, of course, 227. Before we get to that, we need to talk about $119 billion of debt sales across a 3-year, 10-year, and 30-year maturity. It's a busy week ahead.
Starting at 1 p.m. today with $58 billion of 3-year notes and finishing on Wednesday ahead of the Thursday day off for equity traders. Bonds are still going to be traded for part of the day on Thursday. But the idea here is how much demand is there at a time when we've seen bond yields creep up dramatically? And this has come from the real yield sector, not necessarily inflation expectations. Is this deficit concerns, or is this just something that's normal? That basically we're getting back to a re-normalized yield curve.
It's shaping up potentially to be a really important 24 hours. On the debt front, to your point, the amount of supply that we'll get through this week and maybe beyond, we've got Speaker Johnson talking about one big bill being passed by April, perhaps even by May. Now we need to talk about tariffs as well, a more complete picture on the effort from the incoming administration. And we go back to what we talked about through most of this morning. From the Washington Post, President-elect Donald Trump's aides are exploring tariff plans that would be applied to every country, so a universal tariff, but only cover critical imports. This according to 3 people familiar with the matter.
So when you think about critical imports, you think about things that are detrimental to national security and economic security concerns. We need more details, but as Leland Miller has said, this is the sausage being made in real time. My question then would be to the president-elect, what's the pay first? Because he put out a tweet last night saying there will be this one powerful bill, border, energy, reviving the Trump-era tax cuts, including expanding them, like no tax on tips, and all will be made up with tariffs. Well, how is that going to happen if they're not blanket tariffs and they're actually only targeted and narrow?
Get ready for your head to spin with all the potential proposals and the whipsawing from all of the headlines. And this really goes to the crucial point that you brought up earlier today. Stuart Kaiser made it last week. Is this 2017, which was low volatility, big promises, big expectations baked into risk assets? Or is it 2018, which was high volatility with all of the potential implications coming in and sort of seesawing, leading to actually a negative return on the S&P 500? That's really going to be the key, and one of the big takeaways from some of the big moves that we've seen in the FX market on some of these headlines.
There is, of course, potential to be whipsawed by all of this. We've mentioned this a few times already this morning. The incoming president only needs to post on Truth Social or on X and just turn this market in the other direction. But I think this morning's an important stress test. We always say this, you can learn something from the data, the information, or the way the market responds to it. I think what you've learned this morning is that headlines around trade and tariffs are more important to the likes of the Europeans, to the Canadians, to the Mexicans, to the Chinese than they are maybe to domestic American markets.
Which has been one of the big takeaways that a lot of people have said. Basically, the U.S. catches a cold, everyone else catches the flu, especially when it comes to tariffs that people thought just simply put a moat around the U.S. and reinforced its exceptionalism.
And when it comes to tariffs, they could be immediate. Donald Trump on January 21st, or I guess on January 20th, after he's inaugurated, could go to the White House and talk about tariffs and have executive orders on tariffs. When it comes to the big, beautiful bill, that is going to take months of debate and negotiation. And one viewer actually texted me when the Washington Post article came out and said the main issue is that Trump wants tariffs, but he also wants stocks to go up. At some level, you can't have both.
Stocks went up on Friday. They're up again this morning. And I would say some of that came from how smoothly things went down in Washington on Friday morning. We were looking for a mess. We didn't really get one. Speaker Johnson sailing through pretty smoothly.
Yeah, basically, he had one vote. A couple of holdouts said, actually, let's just pause, take a break, came back, got passed through. Just remember what happened, Kevin McCarthy. 15 times he was rejected before he got that House speakership.
I think they've learned the lesson from that mess. Equity futures right now on the S&P near session highs up by 0.8%. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi as stocks recover after a shaky start to 2025. The former New York Fed President Bill Dudley on what he calls the FOMC's communication problem, and Michael Gapin of Morgan Stanley as we count you down to the December payrolls report. We begin this hour with futures positive after snapping a 5-day losing streak to close out last week. Liz Young-Thomas of SoFi writing 2025 can be positive for business, albeit less room for runaway stock returns at these valuation levels and high earnings expectations. Reevaluate the opportunities for buying. There's plenty out there, not at all-time highs. Liz joins us now for more. Liz, good morning and Happy New Year. Let's talk about those opportunities elsewhere. Where are they?
Sure. Well, when you, excuse me, when you look at the earnings picture for 2025, there are some pretty big reversals that are expected, and I think investors need to pay attention to that. We get so obsessed with this tech trade and focusing on whether or not we should be in a handful of tech names or all of tech or certain parts of tech. But the second best sector in the S&P for earnings growth is actually expected to be healthcare this year. And then you look at things like materials, industrials, that are going to see these big reversals from what their results were last year. So I think there are opportunities out there that are not trading at all-time highs.
How much are these opportunities torpedoed if yields don't necessarily come down?
Well, so the question about yields, we know that this 4.5% level on the 10-year has been really critical to the equity markets at large. You start getting to that 4.5% level, markets at large, indices at large start to struggle. When you're looking at the growth trade, so just a straightforward growth trade, that's what's going to get hit first and hardest, largely because a lot of those multiples have expanded so much over the last 2 years, but also because when you just think about the discount rate, this is rational for markets. As yields rise, the discount rate rises, which means that what you're willing to pay for a stock today is lower than what it would be if that discount rate was lower. So yields should put pressure on some of those growth names. That being said, I think investors are going to start looking for opportunities, growth opportunities in different places. And some of those places might be pharma and biotech. Healthcare really lagged the index last year. There's a lot of bad news priced in, bad expectations priced into healthcare right now. I think they're priced for a good opportunity in 25 if investors need other growth options.
Liz, when you talk to investors, how receptive are they to this message? Where basically you've either had big tech that have continued to outperform, or people are getting a little bit nervous that everything has just gotten a little bit elevated and want to hide out in T-bills. I mean, how much are people willing to sort of look into the nuance at a time where some people are worried about peak sentiment?
Well, I think peak sentiment probably happened post-election, and we baked in a lot of this optimism, but without policy clarity. So now we've gotten to a more rational level. We've had this little pullback. We ended the year on a bumpy note. We sort of started the year on a bumpy note because we know that we need more clarity. We need more answers in order to actually trade those stocks for the long term. So how much are people looking into the nuance? I don't think so much yet, because we're in this waiting game between now and inauguration, now and when the cabinet goes in place, now and when we have actual clarity on some of these big policies. Also, when you look at a market that is so driven by momentum, people aren't looking at the nuances. We're looking at the momentum trade. We're looking at where sentiment is driving things. And a lot of times in those environments, you have this FOMO attitude, and that does ignore a lot of the nuances. So I think as time goes on, and if tech continues to come under some pressure, and if there is, perhaps a slowdown in earnings growth, a slowdown in the optimism, which doesn't necessarily mean a pullback, but just a slowdown in the optimism, investors will start to look outside and have to be more nuanced about it. I think profit margins and earnings are going to be a really critical factor in investing this year.
Liz, when you talk about policy clarity, have you gotten any clarity over the past 48 hours from Washington and Mar-a-Lago when it comes to the one big, beautiful bill and hopefully getting it done by May?
We've gotten a little, but as you guys mentioned earlier in the show, the market doesn't seem all that upset by it at this point. I don't think, first of all, it's a surprise to say that we're going to see more tariffs this year. I think we know that, but we still don't know exactly when that's going to happen, how much it's going to happen, and all the different places where it might actually impact markets. So again, it sort of just reinforces we're still in this waiting game. Things are proposals right now. They're not signed in. They're not affecting stocks at this point. Now, of course, as they become more and more realistic, the stock market will price that in ahead of time. But I think the message of today is that, okay, we know there's going to be more tariffs coming. Maybe the message is a little bit different than what we thought 2 weeks ago, but it's still tariffs and we're still not sure. So we have to wait a little bit longer.
Well, if it's still tariffs regardless, even if they're more narrow, is it now time for companies to potentially raise prices?
I don't think that companies are going to get away with raising prices as much as they have over the last few years, because consumers now realize that inflation has come down. It was easier to pass through those costs and those price increases when inflation was rising, wage growth was rising. Now we've got cooling wage growth, we've got CPI and PCE numbers that most people understand are at least at a lower level than they were, certainly not deflationary, but at a lower level than they were. So it's more difficult to justify a pricing pass-through, even with a tariff change.
Liz, can you help us with the week ahead? We have $119 billion of debt auctions. We have the key labor report that comes out on Friday with the expectation of 160,000 jobs printed in December. And then we have the potential for truth postings or any other utterances around the Trump camp. Of those three, which are most important for you?
I'm focused on the jobs report. We also have JOLTS this week. So when you look at just what the market had been focused on through most of 2024, it was jobs. We had turned our focus to the jobs market because it seemed as if inflation had been largely defeated. Now we've got this environment where jobs are still very important. Inflation has again become very important. So this week the story is going to be about jobs. I don't expect there to be any big surprises yet. I think what everybody is watching for is to make sure that we're still expanding the labor market. But one of the tenets of our 2025 outlook is that we have low churn in the labor market right now. And what I mean by that is low hiring, low quits, which means people just aren't moving around quite as much. So this idea of adding a ton of jobs every month, I don't think is something that investors are really looking for. What we're looking for is just no real deterioration in the labor market, because right now, as the Fed has mentioned, the labor market is still resilient and it's pretty well balanced. So what we need is for the labor market to stay stable while the rest of some of these bumps in the road figure themselves out.
We will get a lot of labour market data this week, including JOLTS data tomorrow. Liz, appreciate your time. It's good to see you. Liz Young-Thomas there of SoFi. Looking at the FX market, can't look away from it. 5 weeks of dollar strength, 5 weeks of euro weakness. That's the longest run of euro weakness going back to February of last year. That is not how we start this week. We bounced. Euro dollar up by more than 1%. Euro dollar 104. That Washington Post story really kicking around the US dollar this morning.
Yeah, pointing to the idea of maybe a more targeted approach on tariffs and maybe the sense that Europe would be spared at least even the really significant headlines that some people were worried about with the opening salvos of tariff talk.
Equity's doing better as well this morning. Equity futures up across the board with an update on stories elsewhere. With your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Some details from that report from the Washington Post. It suggests that President-elect Donald Trump is exploring a universal tariff, but would only cover critical imports. 3 people familiar with the matter told the Post that Trump's aides are still discussing the plan to impose the duties on every country. It would, though, be a paring back of the most sweeping plans from Trump's 2024 presidential campaign, where you'll recall he called for tariffs as high as 10 to 20% on everything imported to the U.S. Prime Minister Justin Trudeau is said to be preparing to announce his resignation. The Globe and Mail newspaper said the announcement could come as early as today. It would trigger a race for the party leadership, the winner becoming prime minister. Trudeau has been under pressure from his lawmakers and his party to quit for months. Scrutiny grew last month after his finance minister, Chrystia Freeland, quit. And at the Golden Globes, The Brutalist and Amelia Perez were the night's big winners after taking home Best Picture awards for drama and comedy. The Brutalist star Adrian Brody also winning Best Actor for his performance in the movie, and Brazilian actress Fernanda Torres winning Best Actress for her role in I'm Still Here. In the TV awards, FX's and John's favorite, Shogun, cleaned up, winning Best Lead and Supporting Actor, Best Actress, and Best Series. And that's your brief, John.
Danny, thank you. Shogun deserved to win it all. And I apologise to regular viewers of Bloomberg Surveillance who might have wanted to watch Shogun and had the ending ruined by Bramo a number of months ago.
Really? That's what this came down to?
I'm not sure they're viewers anymore.
Congratulations to them for a record showing at last night's awards
ceremony. I'm not sure they're viewers anymore.
Okay, that's great.
I think they abandoned us after you ruined the show for them.
Too.
Up next, the morning calls, plus former New York Fed President Bill Dudley on the Fed's communication problem. That's next. You're watching Bloomberg TV.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
Payrolls on Friday. The estimate in our survey, 160. This from Andrew Hollenhorst of Citi. Just publishing 120,000. That's what they're looking for, 120. And the unemployment rate rising to 4.4% in our projections for December should remind markets that the labour market has not stabilised and is continuing to soften. Goes on to say risks are balanced to an even softer reading than that. This, I think, plays into what we heard from Priya Misra of JP Morgan just last week on this program. If you missed that, this was the line that stood out. Risks are asymmetric into payrolls this week. Slightly weaker report, and March cut will be back on the table. And we mentioned this, Lisa, back on the table pretty quickly.
Basically, the idea here is if you get a downside surprise, it's going to have a bigger reaction in the bond market, a rally, a bid into the market, as people reassess just how aggressive the Fed might have to be.
Got a rally right now in the equity market, up by 0.75% on the S&P 500. A rally here across the board to kick off the first full trading week of 2025. Let's get you some morning calls. First up, TD Cowen raising its price target on American Airlines to a street high 25, citing improved pricing and a return of business travel. That stock is up by 4.5% in early trading. Your second call from Barclays, upgrading Boeing to overweight, seeing new momentum for production and deliveries. That stock is up another 1.8%. And finally, Stifel raising its price target on Tesla to $492, citing full self-driving and cybercab initiatives as catalysts. That stock is up by more than 2%. Let's turn to the Federal Reserve. Traders looking ahead to the Fed minutes this week and a rate decision at the end of the month. The former New York Fed President, Bill Dudley, calling for the central bank to improve its communication, writing, the better the quality of the Fed's communication, the more accurately market participants can assess how policy is likely to change. This tightens the linkage between monetary policy actions and financial conditions, which increases the speed and precision of monetary policy transmission. Bill joins us now for more. Bill, welcome to the show, sir, and a very happy new year to you. Where do you think the Fed is struggling to communicate right now? On what issue specifically?
I think the summary of economic projections last month was confusing to people because there was a pretty big upward revision to the inflation estimates for 2025, yet it was hard for Powell to explain the sources of that. He noted that the participants don't operate from a common set of assumptions. Some were assuming effects of Trump tariff and deportation policies, some weren't, and some didn't say whether they were or weren't. So each of the projections has a different set of assumptions embedded in it, which makes it very hard to anticipate what the Fed thinks is going to happen and how they're going to react to it.
Bill, is the issue for the Fed right now communication or just not necessarily understanding which direction this economy is going to go in?
Both. I think the problem is they're having trouble communicating how they're likely to react to the Trump policies. Obviously, if tariffs are broad-based, that is one effect. If they're much more targeted, as the Washington Post report suggests, that has a different implication. So there's a lot of uncertainty about what Trump policies are going to be. And of course, the Fed is, uncertain about how the economy itself is going to perform. A key issue for the Fed in terms of the economy is the labor market going to continue to weaken or not? Powell has been very clear that he thinks the labor market is still weakening, and he doesn't want it to weaken any further. So that's why Friday's payroll employment report is so important.
When you talk about a reaction function, this has been one of the big quagmires for people. What is sort of the scenario analysis that the Fed is doing and how they're going to respond to it? Do you think that they have that scenario analysis, or do you think that increasingly by default it is becoming an increasingly data point dependent Federal Reserve?
Well, there's definitely scenario analysis that takes place before each meeting. The staff prepares what's so-called teal book, and in the teal book there's a baseline forecast, but there's also these alternative simulations which suggest how the economy might evolve if things happen differently. I think that's another problem with the summary of economic projections. It's a modal forecast. It doesn't talk at all about what could happen if things turn out differently than what Fed officials expect. So I think one thing the Fed could do is actually do what a lot of foreign central banks do, is actually have a consensus forecast. Difficult to do with a committee with 19 people spread all over the country, but you could actually start to publish the staff forecast. There is a staff forecast available before every meeting, and if you put that out there, you'd have a better sense of, what the baseline assumptions of the Fed are.
But Bill, isn't one of the issues that comms problems is because they don't want to or can't be seen talking about policy? Do you just think the Fed should be more open about policy, all of the members?
Well, clearly what happens on tariffs and deportation is going to have a big effect on the economy in 2025. So I don't think you can avoid, thinking about that in terms of making your economic forecast. I think the Fed is reluctant to talk about it because he doesn't want to get itself engaged into this political discussion. And I think they're worried that will politicize the Fed. So they're trying to think about it without talking about it at the same time.
Is your main concern right now with the Fed communications, or would you do anything differently on policy?
I think they are in a pretty good place right now. I think that they understand that the economy is doing okay. Inflation is a little bit sticky, so it makes sense to wait. They also understand that there's a lot of uncertainty about what policy is going to be forthcoming. And Powell said when things are uncertain, you should slow down. So I think that all makes a lot of sense. I think the big disconnect, I think, between markets and the Fed is where is the Fed heading over the medium to longer term? The Fed says we're heading to 3% federal funds rate. The market says we're heading to something more like a 4% federal fund rate. So there's a pretty big gap about what is a neutral monetary policy. The Fed thinks the neutral monetary policy is quite a bit easier than we are today. The market thinks that the neutral monetary policy is slightly easier than where we are today.
But what did you do with your own forecast when you had Trump coming in volume one? How did you change things? Did you anticipate the changes to policy beforehand or react once it was introduced?
I think I thought that there was more risk in the forecast. So I think the biggest change for me was to talk about risk and uncertainty going up. And I think that's what's happened today. I mean, I think the big transition from Biden to Trump is under Biden, we sort of knew exactly what the policies were. And in fact, over the last 2 years, there hasn't really been much in terms of new policy initiatives. Now we're going into the Trump era, and we know there's going to be a lot of changes in policy, and we don't know yet what they're going to be. So I think we're going from a period of low uncertainty to much higher uncertainty. And that's what's got to get priced into markets. That's one reason why I think the bond market has done poorly over the last few months.
Bill, appreciate your time. As always, Bill Dudley there, the former New York Fed president, looking out to 2025 and beyond. I think today's a great example of that. You know, the market gets to mark-to-market every single day. All this information, the Federal Reserve gets together and every 2 meetings has to put out some forecasts. And there is a big amount of uncertainty around changing policy from the incoming administration, good or bad, depending on what your opinion is. But this morning's a great example. You get the Washington Post. There's a take that maybe the incoming administration dilutes some of the universal tariff efforts we talked about, the campaign trail. All of a sudden, equities rallied by 0.75%. We're ripping in Europe, by the way. The DAX off to the races, euro stronger, bid at the front end of the bond curve, yields down. That's reflecting maybe a Federal Reserve that gets to ease just a little bit more because they don't have to worry about inflation so much off the back of the tariffs. This story could change again in 10 minutes' time.
So how does the Fed respond to this? How do they come out with some sort of reaction function at a time where essentially a lot of things could be changing, and if they want to have some sort of strategic communication, how are they strategic at a time when people do not agree? You have Andrew Hollenhorst talking about a labor market that's falling off, and you have Dan Greenhouse talking about stability. Guys, it's all just fine. Put those things together. Is it a communication issue or just a lack of clarity right now?
Well, according to Bill Dudley, when it's a lot of questions, and to Jonathan's point, can change every 10 minutes, you slow down when there's policy uncertainty. And if you have Speaker Johnson putting out the timeline basically for May to get this one big beautiful bill, if you're the Fed, would you just stay on the sidelines until you actually see that policy become reality?
What Bill's getting to, the post-GFC communication apparatus is no longer valid in this world. It doesn't help. In fact, it hinders. And I think you see that again. Introducing staff forecasts, I think, making them public would be a good idea. And getting rid of the individual members, which I think kind of makes it even more difficult for the chairman to sit there in a news conference and reflect a consensus that doesn't really exist on the committee.
How do we get a sense of their longer-term parameters and expectations so that the market can understand when they'll cut, why they'll cut, and how they'll interpret incoming information?
Up next, we'll get the views of Mike Gapin of Morgan Stanley and Greg Peters of PGIM. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
60 minutes away from the opening bell. We are just off session highs on the S&P 500, up here by 0.8%, up nicely on the Nasdaq 100, up by 1 full percentage point. With your morning movers, let's cross back over to Manus Cranley. Hey, Manus.
Jonathan, thank you. Magical moments of volatility and calls. Boeing, let's kick it off with that. We've got an upgrade to overweight for the first time since 2019. Barclays gets positive on the stock. Why? Basically, the balance sheet is in a better shape. They've got the capacity to ramp production. How much of the MAX will they get back to production this year? They're demonstrating as they go into 2025 a sustained positive momentum for production and deliveries. Uber, roll it over. All hail the buyback. Look, they had a $7 billion buyback program. This morning, they've accelerated $1.5 billion worth of a share repurchase program. We have considerable momentum. We're scaling our free cash flows significantly. These are the messages from Uber this morning. Returning meaningful capital to shareholders while investing in growth. Our stock is undervalued. Well, of course, all CEOs will probably say that. Our stock is undervalued relative to the strength of our business. Let's close it out with Barclays. This has just come on the tape. Barclays on Citigroup, I should say. Citigroup is at an inflection point. Good news for Jane Fraser. They go to overweight at Barclays on this stock. It is the lowest valuation. They look at price to book multiples. JP Morgan 2.5 times. Morgan Stanley trading at 3 times price to book. So there is more breadth in this stock on the upside because of the lower valuation that they have at the moment, despite being up 32% over the past year. So a big call from Barclays at an inflection point on this stock. Jonathan.
Manus, thank you, sir. Appreciate it. The opening bell about 60 minutes away. Before we move on, I just want to mention Europe again. Euro Stoxx 50 is up by 1.7% right now off the back of that story from the Washington Post indicating that perhaps there's a consideration of the incoming administration to dilute the tariff effort. Watch this space. We'll see if we get any pushback from the incoming president later on today. But you're really getting a sense of where the bigger moves will be if that's the course of action. And it's beyond the United States. Euro dollar's up by 1.2%. Euro strength, the biggest one-day move going back to November of 2023, so in more than a year. And Lisa, it just points again to the fact that for European assets, they're at the mercy of US policy right now in a major way.
You asked this question, do they have any control right now over the destiny, right? And you asked this question about the potential lack of leadership there. But earlier this morning, we also got German December harmonized CPI. Inflation came in hotter than expected in Germany. They can't catch a break, 2.9% versus the estimate of 2.6%. You would think that would negatively affect some of these assets, but it didn't matter because really these headlines from the Trump administration took the oxygen out of the room.
Stocks in Paris, France up 1.6%. The DAX in Frankfurt, Germany up by more than 1 full percentage point. Traders on this side of the Atlantic looking ahead to key data on the horizon. December payrolls coming on Friday. CPI following on the 15th. The Fed's first rate decision of the year at the end of the month. Michael Caper of Morgan Stanley writing the Fed may be hawkish today, concerned about inflation persisting resistance and policy uncertainty, but turn dovish tomorrow, particularly if these same policies weigh on economic activity and labour markets over time. Michael joins us now for more. Michael, good morning. I've said this to you a million times. Congratulations on the new seat.
Well, thank you very much. Happy to be here.
Happy New Year to you. Let's talk about the data you're expecting this week. What would it take? How low is the bar to change this story at the Federal Reserve and to get them talking about rate cuts and talk about rate cuts quickly?
Well, I think it's a combination of, you probably need payrolls like below 150, right? Something at maybe below 140, and you probably need an uptick in the unemployment rate. And I'd say our forecast is on the edge of that. We're at 150 on the headline. We do think the unemployment rate ticks higher to 4.3. And honestly, there's like 4 components to this report that are really interesting for me. One is retail. Retail was down in November despite strong spending by households. We're looking for a snapback there. That happened last year. Some of the seasonality issues still persist. Second, construction payrolls. They were strong in September and August. They were basically flat in October. Is that a weather story, or is the housing market just stuck and we're not going to get payback there? Third, I'd say manufacturing. They're down 60,000 jobs over the last year. Auto's down about 25 over the last 4 months. So what's happening there? How persistent is that? So there's a lot of risks around this. And then finally, immigration. It did slow at the end of the third quarter into year end. We expect it to slow further. That should give us a weird mix over time of lower employment growth and lower unemployment. So there's a lot of cross currents. We think this will be a report that says, yeah, the labor market's cooled and it's stable, but there's kind of 4 or 5 risks building around the labor market right now.
I'm looking back, and this is going to be the final jobs report for 2024. The expectation is for 180,000 jobs being created every month. That's down from 604,000 back in 2021 when this was the rebound from the pandemic. What are the key linchpins to help you understand whether this is a cooling or whether this is something more pernicious?
Well, I think to feed into your prior conversations, it's all about the policy outlook, right? So that we feel comfortable in thinking fiscal and regulatory policies are probably a 2026 story. It'll take time for those to come to fruition. But trade and immigration are on the forefront. And both of those could have adverse effects on activity and labor markets. We'll have to see.
Which is the more important question here? The idea of trade and tariffs, which is certainly whipsawing markets today, or frankly, immigration and what gets passed in the first couple of months of the Trump administration?
I think markets would tell you tariffs and trade. And I think we would remind everyone that we think immigration's just as important, right? Jim Bianco was on earlier saying potential growth is running around 2.5. Completely agree, but a lot of that is an immigration story. So if you pull back some of this immigration, you get slower growth in trend hours, slower growth in the labor force, and potential growth can come down, right? That's not going to be a robust labor market. The labor market, we think, will have 2 flavors over the course of the year. Weaker employment growth, but a low unemployment rate. How do you take that signal and understand what to do with policies? So we would say both are important. The market, I think, is more focused on the near-term effects of tariffs.
We could see executive orders almost near term when it comes to immigration as well. Do you have a base case of what 2025 might mean for immigration?
We do. We have immigration slowing to about maybe 500,000 this year. I wouldn't say it's an overly, restrictive situation. We have it more kind of hitting in 2026. But that's a big slowdown from where we've been. And if you kind of look back to a slowdown in global migration during COVID is a proxy for where this could take us. That could easily take 50 to 75 basis points off of potential. So we do have things getting more restrictive.
When it comes to the trade story in this Washington Post, which we've been saying things are very, very early now in these kind of debates and discussions, and Trump is not even inaugurated yet. But if it is going to be potentially narrow and more targeted, does the Fed need to really be that concerned about the impact that can have on inflation?
Well, the answer, of course, is it depends on how narrow, how targeted. But so I think what you heard this morning is consistent with what we're thinking. We never really thought the true universal tariff was on the table. And I think what you're hearing is the direction of travel on this is to try and mitigate third country trade into the U.S. So if you target China and trade gets redirected, how do we set up tariffs to prevent that redirection? But I'd also note the article hinted and said essentially this would be step one. I'm not, we're not thinking that that would be it. We have tariffs ramping up over the course of the year, kind of peaking in the fourth quarter. So I'd say this is broadly consistent with what we're looking for, some opening salvos, initial steps, and things that build in gradually over time, not one big bang effect from tariffs.
I'm not one to hype the Fed minutes, but I actually think the Fed minutes this week could be quite interesting on Wednesday. What are you looking for in them?
Well, what we would love to hear, and I think Bill Dudley alluded to, some baked in policies, some baked in higher uncertainty, some said nothing at all. Anything that would give you clarity in essentially how much was baked in and what. Was it tariffs? Was it immigration? Was it fiscal? I don't think we're really going to get much clarity around that, but that would be.
They get to massage the Fed minutes just a little bit.
A little bit.
Do you think this could make things better or worse when they come out on Wednesday? Because a lot of people walked away from the previous Fed meeting and that news conference pretty confused.
Well, I don't think the minutes are going to help that situation a lot. If roughly a third put something in, roughly a third didn't, and a third didn't say anything, I'm not sure how the minutes clear that up.
Maybe they give us the breakdown of just how many people chose to incorporate it and how many people chose not to.
Yeah, maybe they'll give us a sense of exactly who it was, and maybe they'll give us absolutely nothing.
Name them.
To your point, though, to be completely honest, it could be interesting because they massage the minutes. Do they get more hawkish? Are they taking the signal from the long end of the yield curve as something more negative? And that, I think, is something to look for.
Wednesday, one to watch. Mike, good to see you.
Good to see you.
We'll do it again soon. Michael Capon there of Morgan Stanley. Mike McKee's with us now, Bloomberg Economics and Policy Correspondent. Mike, this week stacked, full of data and those Fed minutes on Wednesday. What are you looking for?
Well, it's always the first week of the month that gets everybody's attention on Wall Street, and we're looking for a lot of potentially market-moving data coming in as people try to figure out what's going on with the labor market, because we get all the precursors to jobs on Friday with ADP coming out and the jobless claims numbers. Those will be released on Wednesday because of the Thursday memorial service for former President Carter. We also have seen the auctions, Treasury auctions, rescheduled into Wednesday and Tuesday because of that Carter funeral situation. So you're going to have a lot of early data coming in that people will be looking at to see where we're set up for. But then Friday, because of Thursday's a day off, Friday's going to be a big day. It's all the focus of the week. By the end of the week we get there, everybody's going to be looking at that.
Michael McKee, looking forward to it. 160 is the estimate in our survey. The previous number was 227. This is a take from Greg Peters of PGIM Fixed Income. This is what he's got to say. The global economy will grow at the same rate as in 2024. The US economy is doing quite well. The biggest risk is a resurgence of inflation. If inflation rises, we could return to the environment of 2022. You'll recall, of course, that 2022 was bad for both stocks and for bonds. Greg joins us now for more. Greg, let's talk about that big risk, and welcome to the program, and of course a Happy New Year. What underpins that risk for you? Where would that resurgence of inflation come from?
Yeah, so I mean, it's not a base case, by the way, Jonathan, but it is a risk, though. And so just, looking at the pace of inflation, it seems to have moderated for sure. You're seeing the housing market still showing signs of inflation. The labor market's still quite healthy. So the seeds are there. Am I expecting kind of resurgence like we saw, back in 2022? Not necessarily, but the fact remains the market has really leaned into this disinflationary camp. So any movement away from that, I think, is a shock to the system.
Greg, given that, are you staying away from Tuesday's $39 billion of 10-year notes being auctioned off and the $22 billion of 30-year notes being sold on Wednesday?
Well, that's part of the self-fulfilling problem, right, Lisa? You have a tremendous amount of debt hitting the marketplace. The supply just keeps coming and coming. I think all else equal, that puts pressure on the curve, puts pressure on rates. And so you have that coupled with maybe inflation being a little more sticky or reversing, moving higher, that puts more pressure on the bond market. So, yeah, I think rates will be quite volatile and, if anything, a little higher than what people envision.
Greg, this seems like kind of a shift for you. You were more positive, more constructive on U.S. fixed income and even duration a couple of months ago. Am I right? What's changed?
Well, so I think some of the policy, items have changed. Our view all along has been a very wide, volatile range, which, professional fixed income manager doesn't like to have such a wide range. But I think that's the environment that we're in. We're spending so much time talking about policy. At the end of the day, we're investors, right? We look at fundamental data, and we're being driven by these policy factors, which I think is, a much more difficult task. But yeah, so, we look at tariffs, we look at some other items, we look at the resiliency in the economy, and that probably points to more inflation, less Fed moves, and higher yields.
You're bearish on energy, and I have to ask, this is a priority for the incoming administration when it comes to, quote, drill, baby, drill, but also deregulation, which should make it easier for energy companies to do well. Why so bearish on the sector?
Well, so I think it's more of a factor, like how much more capacity is there, right? So drill, baby, drill, there's not a lot more that they can do. And so if anything, what drives energy prices is the global economy, China as well. And so we look the supply side, moderating, but then the demand side coming down as well. So I think that's the driving force. And it's important to remember, this was a narrative back in 2016 as there was all this hype and excitement around the energy sector, and it was the worst performing sector. So, just be kind of a little skeptical, cynical around some of those policy initiatives and how it translates into sector performance.
Which sector do you think is going to benefit the most under the incoming administration?
It's hard to say. There's so many moving parts, of course, but one area that we continue to be focused on is the financial sector. Less regulation on the margin, is quite helpful, but fundamentals are really quite strong. And so, we think the, financial sector should continue to do quite well here.
Greg, I know it's not your base case, but if we did get a resurgence of inflation and a repeat of 22, and you, by the way, are not the only one who's raised the prospect of that. Torsten's Lock of Apollo wrote the same thing coming into 2025. What works? Where do you hide when stocks and bonds are both pretty dicey?
Yeah, nowhere. I mean, that's what makes it so scary, right? It's so challenging in an inflationary environment. That's what we relearned in 2022. But, what should do better is some of the commodity-based, segments. But there is no real place to hide, which is why you're seeing, gold being so resilient, right? That is an asset that investors, rightly or wrongly, like to hide in those types of environments. So, I think the playbook, if in fact that base case does come, that risk to the base case does come to fruition, there's not a lot of places to hide from that.
Greg, good to see you back. Appreciate your time, sir. Greg Peters there of PGIM Fixed Income. Finishing there on gold. We spoke to Goldman last week. Goldman Sachs looking for gold to get back towards 3K right now. Lisa, 26, 23.
Yeah, potentially an inflation hedge, as well as the fact that central banks have been buying so much gold. So you put those two ideas together, and the fact that, the sheen off of Bitcoin seems to have worn off. I do wonder whether you still call that digital gold or whether people are actually going back to the physical commodity and whether that's going to be the breakdown this year.
Not to dodge that, just recall the conversation we had with Goldman last week. It was like every single issue was buy gold, geopolitics, buy gold, inflation, buy gold, debt dynamics, buy gold.
Which is the reason why pretty much everyone who we talk to is a gold bug, and it makes me wonder about the gold bars that are being sold at Walmarts and whether they're flying off the shelves.
Costco, quite well, right?
Costco, yeah. Well, yeah. I imagine a lot of people, especially if they're, what are they called again?
They had to put a limit on them. You can only buy so many per person.
I think it's just preppers. It's not just preppers buying gold.
How many gold bars do you have?
I'm not sure we could get into how many gold bars I've got.
For security reasons?
For security reasons.
Obviously.
Yeah. Not that I walk around,
disclosure reasons.
Not that I walk around with gold bars, And what those South African coins called? Cougarans from back in the day.
Well, if
people used to collect them too.
Yeah, I have like a sack.
A lot of people
treasure.
bought gold in 2024.
Yeah.
Let's move on. I don't carry gold. Don't bother me on the street. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President-elect Donald Trump has weighed in on this morning's news that Nippon Steel and U.S. Steel filed 2 lawsuits to remedy the, quote, interference with Nippon's acquisition. Trump writing on Truth Social, why would they want to sell U.S. Steel now when tariffs will make it much more profitable and valuable company? Wouldn't it be nice to have U.S. Steel, once the greatest company in the world, lead the charge towards greatness again? It can all happen very quickly. Elsewhere, it's the first full workday where the New York City congestion pricing program takes effect. It's the first such program in the U.S. 1,400 cameras and easy pass detectors were switched on Sunday to catch every vehicle traveling south of 60th Street and to hit them with a new $9 toll during peak travel times. It's part of the plan to bring $15 billion to the MTA to upgrade subways and mass transit. And the NFL playoff picture is set. In the AFC, the Bills will host the Broncos. The Steelers will head to Baltimore to take on the Ravens. And the Texans and Chargers will face off in Houston. The Chiefs have a first-round bye as the #1 seed. In the NFC, the Packers head to Philly to play the Eagles. Commanders rookie Jaden Daniels will face off against Baker Mayfield and the Bucs. The Rams and Vikings rounding out the matchup. The Lions secured the NFC's #1 seed, guaranteeing home field advantage throughout the playoffs. And that's your brief. John.
Danny, thank you. Appreciate the update, and thanks for this morning. Up next on the programme, we'll set you up for the day ahead, and we'll catch up with Tyler Kendall down in the nation's capital of Washington, D.C. from New York. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As we we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks rallying going into the opening bell. The opening bell about 37 minutes away. Equities up by 0.8%. Your trading diary for the second week of the year and the first full week of trading for 2025 looks like this. Today, US PMIs at 9:45 Eastern, then durable goods at 10. Tuesday, jobs data plus ISM services. On Wednesday, ADP payrolls and Fed minutes. On Thursday, you'll get another round of jobless claims. And on Friday, we will get the payrolls report. Let's turn back to Washington, shall we, and catch up with Bloomberg's Tyler Kendall with the latest on tariffs expected from President-elect Donald Trump. Tyler, welcome to the program. We've got a whole lot to talk about. We've got this one big bill potentially passed by April, May. On the one hand, we've got that effort, and then you've got the trade story. What do you make of the Washington Post reporting this morning, and what are people in D.C. saying about it?
Right, of course. So this reporting is saying that he's considering this, paring back what was a campaign promise for President-elect Trump that he would impose universal tariffs across the board up to 10 to 20%. Here in Washington, I think the reaction would be that it's really maybe working towards appeasing to some Republicans who had previously expressed concerns with President-elect Trump's tariff plans. Think Midwest Republicans such as Mike Rounds or even Senator John Thune, the incoming Senate Majority Leader. He had expressed concerns with Trump's tariff policies, and that was actually one of the sticking points when he was trying to become Senate Majority Leader and didn't outright get President-elect Trump's backing, because when you look at South Dakota, for example, one of their biggest sectors is, of course, agriculture, and many of these Midwestern Republicans had expressed skepticism of what a potential Trump universal tariff plan could mean for their constituents and also their popularity on the ground.
Tons of debate, Tyler, when it comes to the sequencing of how all this would get done, and a massive debate in Congress on whether or not there be one reconciliation bill or two. President-elect is saying there's going to be one. Is the thinking behind this is that you have to cast a wide enough net to make sure that you can get every vote possible?
Right, exactly. So the key part in a reconciliation package is that it needs the simple majority to get through, which means Republicans can plow ahead with this without any Democratic support, but they're going to likely need every single Republican on board. We know that House Republicans actually stayed in D.C., partly because there's a huge snowstorm outside ahead of certifying the Electoral College results today, but also because Mike Johnson, once he won that speakership, said that he needed to go out and start to get all the viewpoints from his respective members, since we know that President-elect Trump wants to see this done as quickly as possible. President-elect Trump had already laid out that he wanted energy, immigration, and tax cuts to be the first three priorities that he accomplishes. This reconciliation package is going to give it all in one punch. Whether or not, though, that Republicans can solve those fissures within their own party, particularly when it comes to spending cuts to offset those tax cuts, remains to be seen, but it's something that they're already starting to discuss.
Tyler, thanks for braving the snowstorm for us this morning. We appreciate it. Tyler Kendall down in Washington, D.C. from the nation's capital. A big effort there. That Washington Post story really shaking up this market across fixed income, foreign exchange, and equities as well.
The idea of just simply tailored or pared back tariffs having a huge boost to some countries. I'm thinking about some in Europe as well as in Mexico. Whether it sticks like the snow, we shall see.
Let's see where we are this time tomorrow morning. This could change a lot. Coming up tomorrow, Julian Emanuel of Evercore, Torsten Slock of Apollo, Jason Thomas of Carlyle, Dana Peterson of the Conference Board. An absolutely stacked show tomorrow morning. Looking forward to having you join us. From New York, thank you for choosing Bloomberg TV. Brave the snowstorm. I hope you're all okay. Stay safe, and we'll see you tomorrow morning. This was Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good congestion pricing morning, 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Now coming up, shareholders revolt. 2024 was a stellar year for corporate activists. We're going to break down the latest numbers with Jim Rossman, Barclays Global Head of Shareholder Advisory.
And the steel deal that just won't die. Nippon Steel and U.S. Steel file lawsuits in a last-ditch effort to preserve a deal. We'll have the latest.
And Chuck E. Cheese, the iconic 80s mouse you love to hate, expanding its entertainment restaurant chain. We'll speak to the company's CEO next hour. All of that and more coming up. Let's take a look at where markets are trading. That momentum we saw on Friday continuing on, at least for right now. The S&P 500 up by about 0.9% in the pre-market, being led in a big way by big tech. You can see the NASDAQ 100 higher by more than 1%. Despite what's going on in the bond market. Of course, we're unchanged right now when it comes to the 10-year Treasury yield, but we're talking about 4.6%. That's close to the highest levels since May or so. A lot of sell-side research out this morning talking about the possibility of what that means for risk appetite in the equity market. Matt Miller, are you scared?
Yeah, that could be dangerous for stocks. But our first guest this morning says the most important rate to watch is the unemployment rate. Of course, we're going to get the final reading of that for 2024. I have behind me the non-farm payrolls report that comes out at the same time on Friday. And we're looking at a lower peak than we saw throughout the rest of the year. Still 160,000, so better than a stick in the eye. But could it be a downturn for stocks?
Not yet too much fear from me or the market, certainly not from you, Matt. We're taking a look also at some individual movers because you are seeing that optimism back. Chip stocks like Micron are surging today. Traders are piling back into that AI trade after the year-end sell-off. Fubo absolutely soaring this morning after Bloomberg reported that the streaming provider and Walt Disney are nearing a deal to combine their online live TV businesses. Fubo is just on a tear, up about 200% nearly this morning, about 190%, that Magic Kingdom boost. Finally, the steel deal you're talking about, Nippon and U.S. Steel jointly filed lawsuits against the White House's decision to block the merger. U.S. Steel now up 4.4% this market. Of course, we saw downdrafts last week after we saw Biden officially shutting that deal down. And of course, the president-elect coming out on Truth Social this morning saying that they should be independent. They should just wait for those tariffs to save them, Matt.
All right, there's a lot to talk about in terms of single stock stories today. We're going to cover all of those, but the top of my mind really is the congestion charge. It's the first day. It's a new era for New York City, right?
How was your commute in?
So I have always said, if the congestion charge is big enough, I will take a train instead of driving. Because the idea is you want to drive behavior. You want to change people that are, you know, one person in a big car with a 6-liter V8, you know, driving in and out every day is not good for the environment. But it's $9.
Yeah, where I fall on
I drove.
You drove. Where I fall on it, of course, I live, you know, in Manhattan, so it doesn't really affect me. But where the money actually goes to and how it's spent, of course, it's supposed to be spent electrifying buses, I believe, and improving the subway. That all sounds good. I'm really curious to see if that actually happens.
It also falls below 60th Street is where you have that pricing cut in. So what happens to pricing above that for things like parking garages, for other types of amenities?
But by the way, you drove as well, right?
I did.
So
and right
$9 wasn't enough to sway me or you.
But did you know it's phasing into $15 over time?
Yeah, it's brutal. The biggest question I have, of course, is how does congestion pricing affect the 10-year Treasury?
Okay, this morning, we got Morgan Stanley saying that these rates are the most important thing to watch.
You can say his name, Mike Wilson.
Mike Wilson for stocks. However, Stuart Kaiser said no. It is not the 10-year Treasury rate that's the most important thing to watch for the direction and leadership of stocks. Rather, it is the unemployment rate. And he is Citi's head of equity trading strategy. He joins us here at the desk. Stu, I guess this is a debate the Fed is having as well, right? Is it labor or is it inflation? And you're looking right now, you favor the labor picture as the sort of canary in the coal mine.
Yeah, 100%. I think the Fed is clearly more focused on the growth side of their mandate than they are on the inflation side, and they specifically called out the unemployment rate as kind of the key thing they're watching. So to us, the unemployment rate is the most important kind of macro data point you're going to get each month. And look, the bottom line is the 10-year yield is a price, right? And that price reflects the data. So if you're getting a higher 10-year yield from here, I think what that's telling you is U.S. growth is strong and positive, and that's net good for equities. The fact is, to get the 10-year rate significantly lower, I think what you need is weaker U.S. growth. And if you're a U.S. equity investor, you should not be hoping for weaker growth. You should be hoping for stronger growth.
There's two interesting points in there, both that you're so focused on the unemployment rate and not inflation, since we talked to a lot of inflation worry reports, but also that you say the direction and leadership of stocks. Explain what you mean by that.
Yeah, look, I think, it's my point. If you get higher yields, I think that's coming from a positive growth picture. That's good for equities higher. And if you're getting a positive growth impulse, that's the type of thing that's going to get your small cap and your cyclicals working and kind of catching up a little bit. So I think a strong unemployment rate, lower unemployment rate, higher yields, I think that's a pro-cyclical trade. It's equities higher. It's a little bit of a catch-up of some of the laggards we've seen.
But when you think about growth, why do you think that that's kind of the main driver here? Because ultimately, you're seeing that fiscal term premium really be baked into the 10-year. Doesn't that start to complicate the equation moving forward?
I mean, look, the reason we're focused on the unemployment rate is because the Fed is, right? So if that is how the Fed is making their decision, then that's what we're going to focus on the most closely. I think when you're talking about bond term premium, I'd be much more worried about that at the longer end of the curve, like out at the 30-year point. And the logic there is pretty simple. If the 10-year yield, let's say, got to 5.5, I could paint for you a good reason why that could happen. If the 30-year yield, let's say, gets to 5.5, it's very hard to come up with a good reason why that yield is moving. So I think if you get bond term premium steepening, particularly at the long end, that's telling you, deficits and fiscal spending and tariffs are really starting to impact the market. And yes, that would worry us. So we are concerned about the bond term premium, but a little bit more at the longer end of the curve than at the belly.
I'm looking at the loonie right now. You can buy 1.42 for the dollar. That continues to drop as we get headlines across that Justin Trudeau is going to step down as the leader of the Liberal Party. And of course, then that would mean that he steps down as PM. And it's a fascinating story that we sort of have gotten telegraphed throughout the last 24 hours. This started when Chrystia Freeland, really kicked off when Chrystia Freeland wrote a scathing resignation letter. But for those of you watching Canada, I imagine you're watching the U.S. dollar, Canadian loonie, first and foremost. And as you can see, that continues to fall as we get these headlines.
A lot of this has to do with what has happened in really recent days. You have Canada reacting to the president-elect policies here, and that impacting their own political situation. We're watching the dollar as well. How do you take into account that rise in the dollar relative to world currencies and how you make your decisions about U.S. equities?
Yeah, generally probably a little bit less concerned with the dollar than some other folks are. I mean, I think really to impact equities via the dollar, you need the dollar to move significantly and to stay high. Because a lot of the corporates kind of hedge their FX risk for a few quarters out anyway. So I think it does matter from a kind of a risk premium perspective. Like, is the dollar strong because people are trying to hide its safety? So in that sense, it matters. If it's kind of moving on these other factors, probably a little bit less concerned.
There's so many reasons why the dollar is strong, right? You get Trump tariffs coming in. You've got the Fed cutting less than anticipated. I guess a safe haven play could be one of those issues, but it wouldn't be the first that I would think of. Is it for you?
Look, I think if the dollar's strong because of quote-unquote U.S. exceptionalism and there's a large demand for U.S. dollar-based assets, I think that's net positive for equities. If the dollar is stronger because you just have a risk-off, I need to kind of turtle up and hide under the table for a bit of time, that's kind of less positive. But I think what we're seeing from foreign demand for U.S. equities, from large ETF flows, things of that nature, is people are buying the dollar and buying U.S. assets not because they're concerned about growth, but because of a scarcity premium of large-cap tech stocks globally, which is what we happen to have.
Well, I also think those yield differentials are so powerful right now.
Good point.
You think about 10-year yields up 100 basis points since the Fed cut rates, began that cutting cycle. It doesn't quite make sense, but let's talk about earnings because we have maybe a little bit more clarity or some clear expectations for what's going to happen there. You think about the Magnificent Seven alone. They're expected to have a combined profit increase of 18%. That's down from 34%. I mean, when you think about leadership in this market outside of what the unemployment rate dictates, what does that potentially mean?
Look, I think it's all a relative story, right? So yes, the growth rate on Mag 7 is lower than it was last year, but it's still significantly higher, than the rest of the S&P 500, for instance. Consensus is EPS on the S&P is going to grow about 15%. I think in Mag 7 it's 18 to 20%, which by definition tells you the SPX 393 is going to grow earnings less than that. I think probably more importantly for a lot of investors, European earnings growth is only about 5%. So essentially what you're telling me is, yes, the earnings growth rate on Mag 7 is decelerating, but it's still superior to the rest of the S&P 500, which itself is far superior to the rest of the world. And I think what that tells us is there's still going to be a lot of demand to own these large cap tech stocks.
Well, beyond earnings, what are going to be the catalysts that really drive investors into certain equities and maybe sectors outside of AI? Is it going to be buybacks? Is it going to be other forms of capital return? Is it still the AI story? If you see it even outside of NVIDIA, do you need companies to mention that more and more, even if they are not a technology company?
Look, I think AI is obviously still a very powerful investment theme, particularly on the power generation side and on that CapEx side. Microsoft last week announcing $80 billion specifically on data center CapEx. That's clearly still important. The NVIDIA chip was running a little hotter than expected. And by hot, I mean, the heat it actually gives off in a data center. I think that is also reads positive. So we do still like that power gen theme. If you're going to broaden out beyond tech, I think what you need to see is what we saw in third quarter earnings and second quarter earnings, which was actually a broadening out of EPS growth, where that SPX 493 is generating positive EPS growth and getting people confident enough to move, kind of down that cap structure, which frankly we thought was going to happen early next year. Last year, it didn't happen until the middle of the year, and I think that is, very much relying on that earnings growth picture.
All right, Stuart, it's great to see you as always. Happy New Year. That is Stuart Kaiser of Citigroup joining us on the set, and to really interesting, of course, start to 2025. You think about how choppy this trade has been.
Super choppy, and a lot of activity happening on the single stock level. The reason I was asking about what the companies can do is you look at Uber, for example, that accelerated share buyback program pushing the stock up 4% or higher this morning. They're front-running earnings, right, which is good news for investors.
So many transportation-related stories.
Do you want to talk about Lucid? Because we've got some delivery numbers out.
I I'm shocked at,
they're
very small. They're very small, but no, 3,099 vehicles are delivered in the fourth quarter for Lucid. That's an incredibly small number.
It's good for Lucid, though.
But it's much better than had been anticipated, right? We were looking for 2,339, so they beat that number by almost 700 vehicles.
Yeah, I mean, with all of these names, it's about the direction of travel and expectations, right? Because you think about Rivian also, of course, a magnitude more than Lucid, but still, it's all a drop in the bucket compared to
But
Tesla.
they also had a good, they also had a big gain, so.
Yeah, a surprise, but when you compare it to Tesla's 500,000 roughly, it's a hard comparison to make.
Right, or the 10 to 12 million that you get at a real automaker. Coming up, we're going to have results from the latest Bloomberg MLive survey of traders and economists. The topic, as Stuart mentioned already, U.S. exceptionalism. We'll break down the results next, and we'll tell you what's ahead for Canada after CBC says Justin Trudeau is stepping down. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get now to high interest, a look at what's making headlines around the world. Canadian Prime Minister Justin Trudeau is expected to announce his resignation as leader of the Liberal Party in the next hour in Ottawa at 10:45 a.m. New York time. That's according to the CBC, Canadian Broadcasting Corporation. Trudeau has been under pressure from lawmakers in his party to quit for months. Calls for his resignation intensified after Chrystia Freeland, his finance minister, stepped down and wrote a scathing resignation letter last month. Now, the Washington Post is reporting that President-elect Donald Trump's team is exploring universal tariffs that aren't really that universal. They would still be covering every country, but only a certain number of products that are critical to the U.S. economy. The policy would mark a more conservative shift than the broader 10 to 20% universal tariffs that Trump proposed to put on all products in all countries during the campaign. The dollar fell against most major currencies on that report. And in New York City, congestion pricing has taken effect as of last night after a judge ruled against New Jersey's request to stop the program. Taking the lead from London, Stockholm, and others, the policy is the first of its kind in the United States, but it's much cheaper than it is in other countries. Drivers entering parts of Manhattan will be charged $9 during peak hours. The initiative promises to deliver $15 billion in revenue to the Metropolitan Transportation Authority, which runs the New York subway system. Shonali?
And I also want to mention that the president-elect has responded to the Washington Post story that we've been talking about all morning here. Of course, this idea of universal tariffs. Trump is saying on Truth Social that the story on critical imports on universal tariffs was incorrect, so he's pushing back quite meaningfully here and flatly calls the story incorrect. We will talk more about it, look into it more as we go along. Of course, a lot of posturing going on in Washington and a big day in Washington as we know it, but we're going to move on. We're going to talk about what Trump's tariffs really mean for markets. We're going to take a look right now at the strength of the U.S. dollar. There's been a U.S. dollar index against major world currencies rising by more than 7.5% since its September lows, and the dollar has mostly held on to its strong rally since President-elect Trump won the 2024 election. According to the latest Bloomberg Markets Live Pulse survey, the dollar might still be one of the biggest beneficiaries of Trump's policies. Joining us now, Bloomberg's Christina Aquino. You know, you look at this run-up, we've already had one, so why do investors still believe there's more room to run in the dollar as we see these tariff policies come to light, especially if some of them might be even lighter than the initial campaign promises?
Yeah, well, interestingly, Shonali, I think there's this really notion that the dollar is going to be supported by more than just those tariff policies, right? There is this broad expectation that President Trump will come in and that will just be overwhelmingly positive for growth. That really is what our survey participants were really harping on, this expectation that growth in the U.S. will be much stronger and, importantly, much stronger than the U.S., other U.S. peers. And that's why that's important, right? It's the relative strength of the dollar that they all believe will really carry the currency through, or at least 51% of our survey participants believe that much anyway.
So that was one leg of the survey. Talk to us about what the survey respondents said about when it comes to the S&P 500. Of course, you have the Wall Street sell-side community finally throwing in the towel on bearishness, expecting about a 10% rise in the S&P 500. What did you learn?
Well, Katie, I think it is also just as positive. We did see 61% of our respondents saying as much. They expect stocks to continue gaining, again, because of the story of U.S. exceptionalism, right? And a lot of that, I think, from the stock side of things, really being driven by optimism over the tech story. I mean, even if there are skeptics over there over whether the AI story will continue into 2025 and will keep propelling stocks, the reality is there really is not much of an alternative out there when it comes to the U.S. tech sector in particular, and really more broadly, the returns that you could get from the U.S. stock market versus other markets in the world.
We have most people saying any treasury yield above 450 on the 10-year is the danger zone, right? Some people are saying 5% is when you really need to worry. What did the respondents in your survey say about high rates and the continue of the stock rally?
Well, Matt, I think there is an overwhelming expectation for treasury yields to keep powering higher, especially into the beginning of 2025. And I think a lot of that is a combination of what we're seeing again with the growth story that comes hand in hand with higher yields, but then also how the Federal Reserve plays into this equation, right? I mean, we did see the Fed officials at their last meeting last year really scaling back those expectations for how much they can deliver in terms of rate cuts this year. Markets are even pricing fewer than that. I think they're pricing, last time I looked, fully pricing just one rate cut and just a little bit more probability for a second one. So a second one's not even fully priced, even if that is the Fed's central scenario. And so that really just speaks to a recipe for higher yields into 2025 for sure.
Christine, what else are you looking out for into this year? Of course, there's a multitude of questions to be looking out for with this market as we stand near record highs still on the S&P 500. What are the critical questions you're asking of investors right now from Markets Live?
Yeah, I mean, I think it really is that kind of interplay between these critical levels that we're seeing across a number of markets, right? I mean, I think Matt was alluding to this point that the treasury yields at a certain level would be considered the danger zone just because, you know, the comparative appeal of stocks starts to diminish really once wants to get yields that high. And the reality is, even though the returns that you could get from treasuries probably not really comparable all that much to stocks, investors would still prefer to hold them as part of their portfolios, right? And so there is a kind of trade-off that you would get for yields at certain levels. And I think the dollar stocks interplay as well, especially if we're heading into earnings season, a strong dollar reflective of a strong U.S. economy. But at some point, that will start to bite, especially for countries or for companies that are exporting their goods overseas, right? That really diminishes the appeal of their goods. So I'd be interested to see actually how much of the currency will get mentioned in earnings report this season.
All right, Christine, really interesting stuff. Really appreciate you taking the time. That is Bloomberg's Christine Aquino. She heads up our Markets Live blog. Let's take a check on these markets, of course. We had some interesting headlines coming from President-elect Donald Trump on Truth Social, basically denying that Washington Post report that he's considering universal tariffs, but on critical imports. Of course, Trump's coming out and saying that story was incorrect. You see the markets right now. You can see the S&P 500. It did react a little bit, of course, taking a bit of a dive, but still firmly in the green right now. The S&P 500 up about 0.6%. Big tech, a little bit better than that. The Russell 2000, this is interesting. This had been your pre-market leader, of course, that small cap index. Now it's just middle of the pack here, of course, up about 0.5%. You train your eyes on what's going on across asset right now. You can see 10-year Treasury yields did rise a little bit on that tweet or post on Truth Social from Donald Trump, and the dollar, too, reacting as well.
Yeah, we do see the dollar moving on that, and you saw the dollar come down on the Post story as well. So it would make sense that when Trump says the Post story is incorrect, and he says his tariff policy will not be pared back, that you see a reversal in that dollar move. This is the DXY. I prefer the Bloomberg dollar index. Yeah, BBDXY. It's a broader basket of currencies.
Yes.
In any case, either way, you see the move up. Coming up next hour, we discuss the sectors poised to benefit the most from an incoming Trump administration with Nancy Tangler. That's at 10 a.m. This is Bloomberg. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
To the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 120 countries across the globe. Bloomberg Television. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
All right, less than 4 minutes until the opening bell. Don't go anywhere. We'll discuss the market moves with Callie Cox. This is Bloomberg.
Been offers before to take over Greyhound, but then in the mid of the pandemic, 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, we're still looking at a second day of gains, potentially even after Donald Trump reassured markets he means universal tariffs on all goods and all countries. We see futures rising 0.7% on the S&P. NASDAQ futures rising 1%. And tech stocks really powered the big rally that we saw on Friday, bringing us up to 59.42 at the closing level. You hear the opening bells on this Monday morning. Down at the NASDAQ market site, you have Headspace. And I'm told it's a great app for mindfulness. That's something that I desperately need. JBT Marel ringing the bell at the New York Stock Exchange. We're going to talk to the CEO and president of JBT Marel in less than an hour, so stay tuned for that C-suite interview. In terms of the major averages, as I said, Katie, we had a rally on Friday, and it looks like we're set to gain again today, at least at the open. What do you see on the averages?
Exactly. Quite a lift to start this week. The S&P 500 higher by about 0.7% right now. Big tech is your leader. If you take a walk among the sell-side research, there's a lot of concern about decelerating earnings growth when it comes to the Magnificent Seven. You're not seeing that today. The NASDAQ 100 higher by about 1%. Small caps also catching a bit here, to a lesser degree, though. You can see the Russell 2000 currently higher by about 0.4%. This had been your pre-market leader. Not the case right now. Let's take a look under the hood, though, and we'll take an eye on NVIDIA, AMD, and Micron, of course, keeping a focus on these chip stocks rebounding. That's after they hit correction territory at the end of the year. Now, some of this bullishness may come from Foxconn's report today of faster than expected revenue growth, but you take a look at some of these numbers. You take a look particularly at NVIDIA, up 2.7%, helps explain why tech, of course, in the driver's seat this morning.
Yeah, super interesting ahead of Jensen Huang's speech this afternoon over at the Consumer Electronics Conference. Also taking an eye at some Magic Kingdom love. Fubo absolutely soaring this morning after Bloomberg reported that the streaming provider and Walt Disney are nearing a deal to combine their online live TV businesses. Fubo is up about 155% at the market open, Matt.
Yeah, it makes sense. Fubo is tiny, Disney is gigantic, and when a giant comes in and buys a tiny stock, they usually pay a premium. Nippon and U.S. Steel jointly filed lawsuits against the U.S. over President Biden's decision to block their $14 billion takeover proposal. The companies say they are confident in delivering a deal at $55 a share. The market, not so much. The shares are up in the live trade, but only 4% to 31.77. So, I mean, as you get a president coming in who ran on America first, is he really going to sell off the steel business of the United States to a foreign entity?
It doesn't seem like he would. I thought this was interesting, though, and this is the story that keeps on giving. You take a look at the statement that both of these companies put out. They said that the U.S. Court of Appeals for the D.C. Circuit, they say that CFIUS has failed to consider this deal on national security grounds. Yeah. We were talking about this last week, that national security grounds is a really broad church, and here it seems like both of these companies seeking a definition.
And CFIUS at least used to be the altar at which these things were really hashed out. If CFIUS couldn't really agree on whether this was or wasn't a national security issue, then it does mean the president of the United States might have more and more say moving forward.
I mean, it's a steel manufacturer, right? What do you need in case of a war?
But you know,
steel, right?
The other thing,
what if you're fighting against Japan?
The other thing, they're coming closer together, but that's besides the point. The other part about this deal that's interesting is that the president-elect made this on the grounds of potential future profits for U.S. Steel with tariff strategy. I know we're going to be talking more about that this hour, guys.
All right, let's broaden out here and discuss these markets with Ritz-Holtz Wealth Management Chief Market Strategist Callie Cox joining us on set, I'm pleased to say. Great to see you in person.
Yeah, it's great to be here, ready to talk about the new year ahead.
All right, well, let's go. I was looking through your notes, and of course, we're talking a lot about the biggest risks. Some people say, of course, it's the unemployment rate potentially ticking higher. Others, such as Mike Wilson, say it's 10-year yields going higher. You say, though, the biggest risk, though, is missing out here.
Yeah, well, I'll clarify that. So it's high expectations, I think. And I do think that there's an element of, you know, if you do underestimate where the economy is, then yeah, you probably will miss out on another decent year of the stock market. But things are moving quickly, Katie. Obviously, we're seeing a lot of speculation around policy, which you just spoke about. We're seeing a lot of speculation around inflation, and if inflation is stalling out. There seems to be a lot of excitement about what's ahead. But if you think about the good years or the blowout years in the stock market, usually you see a lot of fear and skepticism followed by a pleasant surprise. And we're just not set up for that here, which is what we're reminding clients about.
There is fear, you know, in terms of valuations. They're high and frothy. There are people making comparisons to not only the internet bubble, but also to 2007. What's left to drive stocks higher if they're so expensive already and we're already all fully invested? Where does the impetus, the extra dollar come from?
Well, when I say high expectations, it really does. It's this broad assumption that, you know, valuations are quite high, but there could be value elsewhere if you're willing to look. I mean, tech has been the dominant story these past 2 years. So that's what we're reminding people to. Yes, there are high expectations. Valuations on a broader scale are high, but there is value underneath these markets, and conditions are changing quickly.
So the index level, you're saying high valuations, but if you delve in and look at individual stocks, you may make money?
Right, individual sectors, individual styles. We've seen a lot of momentum and growth outperformance recently. Value and yield have been left behind. And I'm not saying that everything needs to catch up. Life isn't fair, you know? But if you're saying that valuations are high here and that you think that that's a deal breaker for the stock market, then I'd encourage you to look a little deeper.
You know, Stuart Kaiser over at Citigroup was taking a look at how those factors were performing, and to your point, value has lagged growth, but quality has been making a comeback. Quality is an interesting factor. How do you differentiate quality from value?
Well, quality obviously speaks to the financials, right? It speaks to the durability of the balance sheet, the durability of cash flows, and that makes a lot of sense. I mean, part of that has been that fear and skepticism has just really driven this bull market higher over the past 2 years. And if you talk about quality, you can throw big tech in there. That's some of the best quality companies on the market. But then you have to think about valuation, what really has driven the price higher. And we think that there are a lot of quality companies that still are being ignored.
Well, I'm glad you brought up tech because that's where I was going to go. You asked the average investor, what's quality mean to you? A lot of people will say big tech. And let's talk a little bit about the earnings outlook for 2025, because it feels like some of these companies, they're macro agnostic. They're going to make money no matter what the 10-year treasury yield is doing. But how are you thinking about the potential for a growth slowdown when it comes to that resplendent Magnificent Seven?
Well, we love big tech. We think that there are a lot of reasons to be excited about big tech companies. They've just gone a little too far here, and expectations are sky high. I said that at the beginning of last year. Obviously, tech had another wonderful year, but it is something to watch, especially when you're stressing portfolio balance, which is what we care about at Ritholtz. We have long-term investors with goals decades into the future. But we remind them that balance is important, right? You know, if big tech does well, you're holding big tech through our index funds. If big tech doesn't do well, then you're going to be happy that you focused on quality and value and, you know, anything outside of big tech. But you're right, the story is good. The expectations are still quite high.
Yeah, on Friday, I think Friday afternoon, Microsoft said they're going to spend an additional $80 billion on data centers.
That's a lot of billions.
That's compute power, and that's only for fiscal 2025, which isn't even through the end of the year, right? So I was looking at the story and thinking, who are they going to give those billions to? Obviously, NVIDIA is going to take a big chunk, but how much does AMD get? Is Broadcom getting any? What about Dell, you know, Cisco? Like, who is getting all this cash?
Yeah, and that brings up another thing, too. I mean, the AI trade is something that everybody's hearing about, and for good reason. And I think this year is the year of picks and shovels. It was last year as well. But the point you brought up, Matt, is, you know, all these, you know, big tech companies and AI leaders are thinking about how to, you know, implement these AI strategies in their workforce. It's not just hopes and dreams anymore. It's, you know, actual strategies. So I think as we see some concrete details come out from big tech companies, we can understand what the next phase of the trade is. You know, what semiconductor companies benefit, what software companies benefit. You know, kind of like thinking of the second derivative of the trade here.
Speaking of the second derivative, you look at the end of last year and you saw that catch-up trade that Broadcom had versus NVIDIA. And you also look at, for example, the S&P 500. You looked at energy companies, Vistra, rising at a rate that was faster than NVIDIA. It is hard to buy the argument that investors have bid up NVIDIA at the expense of some of the picks and shovels provider. Do some of those picks and shovels providers even look frothy to you?
I would say so. I mean, look at utilities, for example. Utilities thought of as a pretty boring sector, but they bring in the energy providers that benefit from the AI trade.
Vistra is trading at 55 times trailing earnings.
Sounds cheap.
Yeah.
Yeah, and I'll be honest here. I mean, luckily, you know, we're thinking long term, so we don't have to be stock pickers that blow the market out of the water every year. But it's an important example, and I think the right way to approach it, especially if you have that broader mandate, is to look across sectors, own everything, lean towards value because you know valuations are high, and hope for stable returns year after year.
Callie, thank you for coming in. Of course, that is Callie Cox of Ritholtz Wealth Management. She's the chief market strategist there. We're going to take a look at some movers under the market right now as well, because Uber is still on the rise. It had announced a $1.5 billion accelerated buyback program. Interesting to see how investors are reacting to news like that. Let's see what the actual numbers say. Also, guys, watching Freddie Mac and Fannie Mae, because you may remember that last week you had the Treasury Department, you had the Federal Housing Finance Agency putting forward a roadmap on what a privatization of the two could look like. Remember, government control has been wrested since that 2008 financial crisis. Freddie and Fannie up 15% today. There's a lot of doubt. The Trump administration itself, a spokeswoman for the transition, said that no policy should be seen as official unless it comes directly from President Trump. But a lot of major investors, Bill Ackman including, having a lot of money on the line for a trade like that.
Yeah, absolutely fascinating story. Another one is what's going on in the hush money trial. Remember Donald Trump paid off a porn star to keep that story out of the news? Well, he was found guilty on 34 felony counts of falsifying business records to conceal those payments to that porn star. I think Stormy Daniels was her name. In any case, the former president, incoming president, has now asked New York appeals court to delay the sentencing in that porn payoff hearing. It's set for January 10th, which is Friday, but the president-elect is trying to have his guilty verdict tossed out as a result of his election victory.
All right, so a lot to keep an eye on there. I'm also keeping an eye on the stock market, the S&P 500 at session highs. We'll talk about all of that and more coming up. Also, Wall Street analysts turning bullish on American Air. We'll have the details in Top Calls next. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Open Interest. Let's take a check on the stock market at session highs right now. The S&P 500, we're back at 6,000. It was a rocky road for a couple weeks there, but here we are, of course, at these session highs. You can see, of course, big tech is leading the gains today. NVIDIA up several percent, 3% or so. That is the biggest points contributor to both the S&P 500 and the NASDAQ 100. The Russell 2000 also higher, even without NVIDIA's influence. You can see the small caps index currently higher by 0.75%. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Barclays upgrading Boeing to a buy as the analyst turns positive on the stock for the first time since 2019. He says upside for Boeing relies on sustained positive momentum for production and deliveries, which we believe BA is poised to demonstrate. We'll see, of course, if that actually happens, but Boeing currently higher by about 1.3%. Next, you have American Air getting multiple Wall Street upgrades. TD Cowen, Melius, and Jefferies all upgrading the airline to a buy. TD Cowen in particular says that tailwinds for the company include better domestic pricing, increasing business traffic, and improved credit card economics. And finally, we have Piper Sandler upgrading Band-Aid maker Kenvue to a buy, citing healthier margin trend. The firm says that shares of the consumer health company have appreciated in recent months, but there is still room to better align with peers. You can see shares up about 1.7%. Now, coming up next, Barclays out with a new report on shareholder activism, with 2024 just shy of hitting the record number of campaigns it set back in 2018. That's next in our Wall Street Beat. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's time now for the Wall Street Beat. Barclays out with a report about the rise in activism across Wall Street, and the authors found that over the past 2 years, 20% of activist targets have seen their CEO resign within a year of the campaign initiation, and that's well above the long-term average of 12%. We're going to discuss this with Barclays Global Head of Shareholder Advisory, Jim Rossman. And if you think about last year, the churn in corporate America was drastic. It was stunning, really. And if you now are a company with an activist knocking at your door, is this the number one thing you have to worry about, the CEO keeping their job?
It is a top priority. I've been keeping this data for 10 years. I've never seen a year in which 27 CEOs were dismissed, essentially, because of shareholder activism. And within the S&P 500, what's interesting is that over the years, activism has been a factor in CEO resignations in about 5% of the cases. Last year, it was 15%. So that's 3 times as likely a reason for an S&P 500 CEO to be fired or dismissed based on activism.
We were actually talking about Fannie and Freddie in the last block. You know, Bill Ackman had kind of gone away from activism, and now it seems like he's being drawn back in. Does Trump have anything to do with this, the new administration?
Well, I think what Trump adds is a period of stability. I mean, as odd as that might sound, we now know who we're dealing with for the next 4 years. We know what potentially the antitrust environment is going to look like. And we also have sort of a glimpse into where rate policy might go for the first time in a couple of years. So a lot of the uncertainty was lifted finally by the results of the election. Now we know what's on the table, and now activists can focus on what's going to work in this next 4-year period.
Well, I want to talk a little bit more about that CEO stat, because we've been watching these CEO resignations come in over the past several months. And it's interesting. You point out in your research that in several cases, you think about CVS, you think about Starbucks, that C-suite change came without even an activist on the board necessarily.
I think the two words I'm using this year to describe the board's attitude towards management is aggressive and impatient. And if you also look at a couple of the other CEO departures, Stellantis, Intel, you didn't even need an activist, right? The boards took action. And I think that's the result of an impact of shareholder activism over a long period of time. Boards are no longer waiting. They're impatient. They know that their jobs are on the line in a way that didn't exist in the past, particularly with the arrival of the new legislation, the universal proxy, which if there is going to be a fight at the ballot box, it's not going to be slate versus slate. It's going to be director versus director. So I think the boards have changed, a new standard of governance.
Those are also some standout failures, though, right? I mean, Katie, you wanted to do a story on the fall of American icons.
Yes, I still
Surely
do.
Intel is in there, right?
Yeah.
I don't know if Chrysler fits anymore, but Boeing, Starbucks.
And no vocal activists there. And if you pull up, it's interesting to see that tension between boards and CEOs surface. But the types of activists you're seeing, you still have Elliott, of course, being the most feared kind of leader in the board there with 14 campaigns that you have seen them do last year. But then you hear names that are lesser known to many investors: Strategic Capital, Oasis, Irenic Capital Management, 7 campaigns, being one of the top 5 activists last year. Should companies start to fear the fact that more investors are getting into the activism game, because even the ones you may not have known as drastically could be the ones that are ousting you later on?
That's right, Chanel. In fact, I'm starting to think about the entire asset manager community. 160 investors, why even call them hedge fund activists? 160 asset managers decided to use activism as a strategy to force change. That's a broadening out. Why is that happening? Well, if you look at most shareholder bases, who owns 30 or 40%? Index funds and quants. Who's left to do the job? And I think for a long time, traditional shareholders ceded that to activists. What's happening now is a whole new generation of asset managers who in the past might not have adopted this strategy. They're like, well, if we don't do it, we're not going to sit around and wait for Elliott to do it or Vanguard. Like, why don't we step into the breach?
That's very cool.
Well, you also point out that you had 45 first-time activists, and I just find what you're describing really interesting, because you sort of put that against the fact that short sellers have kind of gone underground in a lot of cases, and at the same time you're seeing a lot of activist investors come out and actually enter this world for the first time. I wonder how you think about those two things.
Well, there's a broad set of targets. Not everyone is a Magnificent Seven, right? Everyone asks me this question. Well, the market's up. Short sellers are hiding. What's the problem? You know, why do we have so many activists? I'm like, well, there's 7 companies that are doing really, really well. There's a Russell 3000 to look at. 65% of companies targeted by activists are actually small and mid-cap companies. So there's plenty of territory for shareholders to look to for activism.
You know, it's interesting. I was thinking about Katie's comment of the fall of the American icon. You also have to wonder if it's also the fall of the American conglomerate. A spin-off index that Katie likes to look at, too, has just absolutely soared over the last couple of years.
Close to record highs.
It's not just companies coming together, right? It's companies falling apart.
Yeah. Well, that's a pendulum thing, right? That happened in 2000.
Right.
And then they all got back together, and then they all get broken apart. That's just money for bankers.
So here's a new factor.
Yeah.
The convergence of private equity and public markets. Many companies now are owned privately. And if you looked at the Apollo September, right, investor report, big question mark over, they're done with going after private debt. The public equity markets are next. I think there's an arrival of the private equity sort of theme of how you manage a company, how you hold CEOs accountable, are coming for the public markets.
This is fascinating stuff. We have to get you back Jim, thanks so much for joining us. Barclays Global Head of Shareholder Advisory, Jim Rossman, talking to us. I want to quickly mention that Canadian Prime Minister Justin Trudeau is going to quit as the leader of the Liberal Party. He's led for 12 years. He's been Prime Minister for 9 years, and that brings up a new PM race as well. We're going to get a statement from Trudeau out of Ottawa at 10:45, so just about 50 minutes from now, and we'll bring you that live. Coming up in the next hour, the CEO of Chuck E. Cheese is going to join us to talk about this business that has been through twists and turns as well. We'll hear about it from David McKillips in the next hour. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. A powerful snowstorm is bearing down on the nation's capital. Mayor Muriel Bowser's message:
stay home. Please stay off the roads. Give our plow teams plenty of room to work during and after the snowfall.
They've already gotten up to 8 inches in D.C. Schools and federal offices are closed. Parts of Interstates 395 and 270 North temporarily closed because of tractor-trailer crashes. The system originated in the Midwest. Correspondent Chris Van Cleve believe is keeping track of travel.
In Kansas City, Missouri, icy roads forced stranded drivers to abandon their cars and trucks. The treacherous conditions sent big rigs jackknifing, and a Kentucky state trooper was hurt after his patrol car was slammed into during the storm.
More than 3,000 flights in the U.S. have been canceled or delayed today. Just in from New York, President-elect Trump's lawyers have asked a judge to halt Friday's hush money sentencing while he appeals the ruling. This past Friday, Judge Juan Marchand said Mr. Trump was unlikely to face jail time or other penalties for allegedly paying off a porn star. While Congress meets today to certify November's presidential election results, the fate of the January 6th Capitol attackers is still unclear. Correspondent Cammie McCormick reports.
Attorney General Merrick Garland issued a statement on this 4th anniversary, calling it an unprecedented attack on our system of government. Over the past 4 years, he says, prosecutors, FBI agents, and investigators have conducted one of the most complex investigations in the Justice Department's history. Nearly 1,600 people have been charged. More than 1,000 have pleaded guilty. Others were convicted at trial, and at least a handful are still fugitives.
Mourners in Atlanta lined up all weekend to pay respects to former President Jimmy Carter, among them DJ Bennett.
He did a lot of diplomatic work. He did a lot for humanity. I think his legacy as a real kind, gentle man would stand.
Mr. Carter's casket will be transferred to the U.S. Capitol tomorrow, where he will lie in state before a state funeral Thursday. The first congestion pricing plan in the nation has hit its first rush hour in New York City. Some subway riders are for it, others bracing for crowded trains.
I heard the chairman of the MTA said the point is like trying to make people make use of the subway. I think it's a great idea, for real.
It'll be way more people on the trains, especially that the congestion prices are going up.
The price, $9 a day for entering the city below 60th Street. Transit officials hope it'll cut the number of cars and trucks in Midtown. Dow's up 244 points. This is CBS News.
Or CVS.
A new trial's begun for a former French president.
Former President Nicolas Sarkozy is accused of illegally accepting funding from Libya for his 2007 election campaign. The prosecution claims he made a corruption pact with Libya's then leader Muammar Gaddafi. Among the 12 others on trial are 3 former French ministers. Sarkozy will appear in court wearing an electronic bracelet as he is still serving a sentence for corruption in a case linked to the investigation into the campaign funding. Elaine Cobb, CBS News, Paris.
Canada's Prime Minister Justin Trudeau has a news conference scheduled in about 45 minutes. The CBC reports he'll announce he intends to step down as the country's Liberal Party leader, but will stay on until they choose a new one. Polls show his popularity has plummeted amid President-elect Trump's tariff threats and the resignation of key allies. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well. Alex Steele and Paul Sweeney here with you today. Coming up, we're going to get the latest on the markets. Vince Signorella, he covers all the markets for Bloomberg News. He's going to join us. Michael McKenzie, Bloomberg rates reporter, going to give us his thoughts on what the markets are saying about the Fed policy going forward. Right now, the markets are kind of discounting about 2 rate cuts in 2025. Shanna Sissel, President and CEO of Ben Ryan, is going to join us and give us her market call. We got a lot happening in the next hour as well. 10:45 a.m. Wall Street time, I believe.
Yep, Wall Street time, 10:45.
Mr. Trudeau of Canada, the reporting is that he will likely step down maybe as party leader is kind of where we are right now, then maybe call for an election.
What we know is 10:45 there'll be comments. He may not actually step down as PM today. He may just step down as party leader, but de facto, eventually, once there is a new party leader, he would be down from PM spot.
So we'll bring that to you at 10:45 Wall Street time. Right now, let's go to John Tucker and get a Bloomberg Business Flash. John, what do you have?
All right, guys, we're data dependent, so let's start right there. The stuff that hurts when you drop it on your foot. Durable goods, like stuff like refrigerators and stuff.
I think you'd break your foot if you dropped your refrigerator.
Yeah, refrigerator. Okay. Actually, I have maybe once. Durable goods orders down 1.2%. That exceeds the expectations of down 0.5%. So there you go there. The major stock averages, they are pushing higher. You had 7 of the 11 major industry groups in the S&P 500 up, being led by information technology. And it is the tech stocks leading the way. NVIDIA, Microsoft, Broadcom, Alphabet, all leaders in the index. And we're going to hear from the CEO of NVIDIA at CES. Ahead of that, the shares of NVIDIA right now, they were up close to 4%. In the meantime, Lori Calvasina at RBC Capital Markets maintains her year-end target of 6,600 for the S&P 500.
This idea of frothy sentiment, it's really been weighing on investors, I would say over the last 6 weeks of the year, but it does look like it's a self-correcting problem at this point. And I think at the margin, it gives us a better setup, the fact that people are worried now, coming into the year.
And then some of the individual stock stories. Fubo shares, they're rocketing higher. Let's see, up 132%. Fubo and Walt Disney nearing a deal to combine their online live TV businesses. Paycor also getting a big lift today. The larger payroll processing company Paychex of Rochester, New York, I believe, said to be in advanced talks to acquire the company. Right now, the S&P 500 up 64 points. That's a rise of 1%. 6,006 on the index. Dow Jones Industrial Average up 287 points. The NASDAQ 100, 295 points higher. That is a rise just about 1.4%. And the 30-year, the bond up 0.6, up right now 484. That is up 3 basis points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Just check the snow cam in the Tucker yard.
He's a nice dusting.
It's snowing at the shore.
Yeah,
he's a nice
Spring
dusting.
Lake, I got that.
Yeah, it's nice. It's nice.
Still coming down.
I mean, we'll see. I haven't seen anything. I can't turn my head that far. But do we have anything outside here?
No.
No, not yet. Okay.
See, but John lives on the top of a very large hill.
Right.
Good luck getting up and down that.
He has ski poles. That's why he joined the gym. He has to learn how to ski uphill.
The Subaru has new tires on it.
Okay.
We're going to make it.
There we go. Happy Monday, everybody. Alex Steele alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. I want to get digging a little bit more here on what's really moving the markets, particularly the dollar. Some amazing stories circulating. Vincent Signorella, Bloomberg macro strategist, is joining us. He also is recovering FX trader. Hey, Vince, what are you looking at when it comes to the dollar? I mean, just a few days ago, it was 102 when it came to euro dollar. There was a lot of movement around this tariff news or potential news from the Washington Post and then from President-elect Trump himself. What do you make of this action?
Yeah, it just smacks of what I think we're going to see for at least this first quarter, which is a lot of volatility. The president-elect will be the president at some point, and his comments and whether he goes forward with those tariffs, excuse me, will largely affect where we see the dollar going. And at this point, if we take him at his word after his tweet this morning, he's sticking to those tariffs, and that's likely to cause a lot of trouble for the dollar.
So, the traders you talk to, Vince, have they dialed down their risk at least for the next few weeks until we figure out what maybe some of these early policies may be, or they just say, "Hey, we're in this thing, baby"?
No, they've definitely dialed down risk, and that's why you see the movements that we're seeing, the volatility we're seeing, is that the positions aren't that stable, and so they're moving very, very quickly with the remarks. You know, obviously the Washington Post story moved the dollar, and then Trump's tweet that story was inaccurate or false, of course, moved the dollar, but it moved all risk assets. As the dollar moved, commodities moved, treasuries moved, so equities moved. Everything was on the run with these comments, and we're going to expect more of them. During 2016 and 2020, Trump was tweeting on a regular basis, causing me a lot of misery, and I expect that as long as I last here, the next few years will be the same.
Well, funnily enough, though, the S&P is around the highs of the session-ish, up by about full 1%. So what are you noticing in terms of the equity market in relation to these headlines?
It's a very similar story for equities. I think traders have pared back some of their positions in equities going into this year. We saw it at the end of December, of course, and whether you wanted to call that profit-taking or people just liquidating positions, it was probably a little of both. And now we're coming into the new year, and those positions are being put back on. Early on, we're seeing the bid and risk. It depends. You know, the big thing with equities this year is going to be earnings, you know, as it should be. But the bar is a lot higher, I think, this year, given the valuations than it was last year. So we're going to really need to see some solid earnings from the corporate world to keep us going in the equity market.
All right, Vin, thanks so much for joining us. Vin Signorella, macro strategist, Bloomberg News, join us here. Give us thoughts on these markets moving higher here for sure. One of the questions is kind of, what's going to happen in the rate market? I'm looking at the 10-year Treasury. We're back up to 4.63%. Man, that's a high yield. I mean, I thought the Fed was cutting rates, so I don't know what's going on out there. Maybe our next guest will. Michael McKenzie, Bloomberg rates reporter for Bloomberg News, joins us here on our studio. First, where is the University of Western Australia? I'm guessing it's in the western part of Australia, but
it's Perth.
It's Perth.
Perth, yes.
How is Perth? Should I go to Perth?
You should. I was there in November for my mum's birthday, so it's a beautiful, beautiful city. Gets a lot of sunshine. Winters are mild. The summers are very hot. So November, December is usually a good time to go.
See, there
That sounds amazing. I think we need like a field trip.
Very good. Wine, good beers. It's got everything.
It's got everything. That's right. It's got everything. So, Michael, what do you make about what's happening in the rates market here?
This is a bond market that really wants to push yields higher, particularly 10 years and out. This is a bond market that doesn't really know what the Trump administration is going to deliver. It's been hearing good things from the potential next Treasury Secretary, Scott Bessent, saying we want to get the deficit down, but no one really believes that in the bond market. There's a real concern here that over time, the deficit and the need to keep rolling over Treasury debt is going to really punish investors. So you don't really want to own 10s and 30s. That said, we are going to get a couple of auctions this week. 10s tomorrow, 30s on Wednesday.
3s today.
3s today. There's also a lot of corporate debt coming as well. And I guess talking to some investors this morning, they're saying that 10-year at 460 is really good for value-orientated investors. But the real issue here is if you look at bond flows over the last 12 months, they've really gone into bond funds that have very low interest rate risk because cash has beaten bonds for the last 4 years straight. So you've been better off just sitting your money in T-bills. So really the story here for the bond market is there's a lot of wariness about the deficits. There's also wariness that Trump could kickstart the economy. Inflation gets rekindled a little bit more, which is kind of what the Fed pointed out to us last month when they had the final meeting for last year. Beth Hammack dissented, saying you shouldn't be cutting rates here because I'm worried about inflation. So this is all coming to a point. So we'll get an idea this week of how comfortable people feel about taking down a 10-year at 460 and a 30-year that seems to be heading towards 5%.
Yeah, and the 30-year, the highest since November of 2023, and kind of sticking around there at the end of the day. Here's the interesting part. Mike Wilson and Morgan Stanley talked about how U.S. equities could face a tough 6 months as the Treasury yield surges here, and that correlation has turned decisively negative. Which, is that the way you guys see it, or is it sort of the absolute level of the yield, or is it the velocity and change of the move?
It's the volatility.
Oh my God, I said velocity.
It's the volatility.
Is there like, I feel like this is the Tom Keene like thing.
Yeah, you have to put
you
a
can
dollar,
only say
a dollar
between
in a jar.
7 and 10. Okay, dollar in a jar. Go ahead. Sorry.
Yeah, it's really the volatility here. I mean, if you're worried about interest rate exposure, you don't want to have too much if there's just so much volatility. And talking to an investor this morning who kind of laid out the game plan, we don't know what the Trump administration is going to deliver in terms of policies. You're better off staying in the sort of front end of the curve, the 2-year, 3 to 5 years. You're better off having a curve steepener on. So what we're seeing here is the curve is steepening. The 2-year is holding up pretty well because it's actually below the Fed funds rate of 4.33 at the moment. and that's seen as value. I guess talking about equities, that's really interesting because as bond yields continue going higher, if they do, at what point does the equity market start to crack here and feel the pressure? And if that happens, then you do want to own a bit more exposure in interest rates like the 10-year. So it could turn out that taking down a 10-year this week around 460 could be a pretty good view if equities have a wobble from here.
For the last several years, the yield curve, when you look at the 2s and 10s, has been inverted. Now we're back to positive.
Yes.
I'm not sure what the word is, but the 10s,
normalization.
Normalization is the 10s are at 463, the 2s at 428. Does that mean now the world's back to normal?
I think it does. I think if you go and look at what the yield curve, where yields were pre-2007, we're kind of back in that world again. We've got real yields, which are inflation-adjusted yields, above 2%. You've got an economy that's growing at least 2% plus. You've got inflation in this sort of 2 to 3% range. So it makes sense that yields are in this sort of range here at the moment. And you can talk to people and they'll tell you, look, the 10-year is probably going to bat between 4% and 4.75. So you're at the upper end of this range. I expect the 10-year auction does okay tomorrow.
Well, also raises the question that all that money in money market funds that keeps hitting record after record, like, why would that go anywhere at the end of the day when you can yield more, especially the money in high yield savings account? You cannot lower my rate anymore if the Fed stops cutting. I'm just saying.
Exactly. Look, I mean, money market funds, it's been a really good place to park your money. The bond market will tell you, look, you should be starting to extend out. Certainly if you see 5 years and 10 years at these levels, we do know at some point the economy could take a downturn, and so you do want to have that locked in. But I think at the moment, there's just so much uncertainty here for a lot of people. It's really difficult to get anyone to be really bullish on the market or really aggressively bearish on the market here.
All right, Michael, thank you so much. We appreciate that. Michael McKenzie, rates reporter for Bloomberg News, graduate of the University of Western Australia. Wow.
Yeah, that's really cool.
I've been to Sydney a couple times just for work.
Yeah.
So nothing fun.
Sydney's really fun.
It is.
I mean, I kind of think, like, if you're living on Bondi Beach or, like, near, and that's what you see every day when you go to work, how can you be sad?
Exactly.
I don't know. Doesn't that just help your commuting?
far away.
It is just far away. All right, coming up, we're going to talk to Shana Sissel, President and CEO of Banyan Capital Management, get her take on the market, particularly earnings and what to expect. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News with this Bloomberg Business Flash. Technology companies lifting stocks today. NVIDIA leading the gains in the mega caps. This comes ahead of the speech today at the CES from the CEO of the company. Right now, as you look at the S&P 500.